Please join us by taking a seat. Good morning. I'm Chuck Harry, NIC's Chief of Research and Analytics. Brian Jarutka, our President and CEO, has taken ill and regrets that he was not able to join us this morning for the Investor Summit, addressing the Forgotten Middle, NIC's Middle Market Seniors Housing Study. NIC is a not-for-profit organization, and our charitable class that we serve are America's elders. NIC's mission is to enable access and choice for America's elders in housing and care by providing data, analytics, and connections that bring together investors and operators. It's with that in mind that we underwrote this study and are hosting today's summit. With the first boomer turning 83 in 2029, social and economic forces will make the care of aging boomers challenging. Unpaid caregivers, such as spouses and children, are often the first option for many elders. However, boomers are less likely to have a spouse, and boomers have fewer children to serve as caregivers. Boomers also were on the leading edge of the nation's shift away from pensions, and much has been written about the saving habits of boomers relative to previous generations. Therefore, there is concern as well regarding the financial abilities of boomers. This study focuses on the forgotten middle. It's based on the following understanding. There is a senior population cohort on the upper end of the financial ability who can afford current private pay seniors housing and whose needs are being addressed by the existing private sector. On the lower end of the wealth spectrum, public assistance and subsidies exist to serve that population cohort. This study focuses on those in the middle, those seniors who have too much wealth to qualify for government assistance, but not enough wealth to afford the existing private pay seniors housing and care. In order to make both business and policy decisions, one requires data. In this case, how big is the size of this middle market population in question? What are their financial resources, not just income, but other resources as well, like stocks, bonds, and IRAs? We've also included the equity buildup by seniors in their homes. We also know that there's an important connection between housing and overall health. Mobility and the need for assistance with activities of daily living are also drivers for choosing to enter assisted living. Therefore, it's important that we look at key health and mobility indicators among the population as well to understand the size of the issue and the associated opportunity. This is its first of a kind study on the middle market, was actually released last month on the 23rd of April at a Health Affairs sponsored policy briefing in Washington, D.C. Health Affairs is the nation's leading peer-reviewed health policy journal. The study looks at financial wherewithal matrixed by healthcare needs to provide investors, operators, and policymakers with foundational information to make strategic decisions on the issues and opportunities associated with the forgotten middle. The goal of this study is to provide the data necessary to allow both public policy and private sector investors and operators to understand the size of the middle market opportunity and to begin a dialogue around potential solutions. The hope is that by illuminating the opportunity, investors, operators, and policymakers will be able to consider new solutions in seniors housing and care to address the need and opportunity in the forgotten middle market. Before we kick off the program to present and discuss the data and potential implications, I'd like to thank all of those who helped get us here today. First, thank you to our Investor Summit co-sponsors, both Institutional Real Estate, Inc., who's represented today by Cynthia Cudrin and Jonathan Shine, and Real Estate Capital Analytics, represented today by Bob White, President and Founder. Also, thank you to NIC's advisory group, who helped make sure that we were focused on metrics and measures that matter, that can be used to help guide business and policy decisions with the needed results. Our advisory group includes Judy Marcheski of 180 Leisure Care, Bill Sheriff of Sheriff Consulting, John Mark Ramsey of Cintio Investments, Kai Sao of Eclipse Senior Living, and Dan Lin of Presbyterian Home and Services. I also want to thank Cynthia Quinn of the University of Maryland Medical School, who has been involved with this project since its inception and helped guide its direction, and our partners at NORC at the University of Chicago, Caroline Pearson, Rupa Datta, and Sai Longathan. A special call out to these folks who worked tirelessly on this study and accepted many rounds of suggestions and feedback. A call out to Shelby White as well, who patiently helped us pull together the final documents for this study. Thanks to this morning's panelists who've invested their time in both preparing for their discussions and being here today. The names and bios of all of our distinguished panelists are in the final program distributed, I believe, on the chairs. I'd like to thank NIC's dedicated staff for the time, energy, and effort put into this study, especially Lana Peck, Bob Kramer, and Beth Mace. I'd also like to thank our events team, led by Jill Gately and Patricia Hardy, as well as our marketing team, led by Marianne Donahue, Will Marshall, and Lizzie Kerr. Finally, I'd like to thank all of you for being here, for being engaged in the early phases of this discussion as we embark on a journey to determine how the broader we might help to provide a mix of private and public solutions to help address the forgotten middle. Now, please join me in welcoming Beth Mace, NIC's Chief Economist and Director of Outreach, who will present the findings of this illuminating study. Beth.
Wow, we're here. We've been working on this a long time, so it's really good to be here today. Thank you all for coming. This is great. So the layout for this morning is I'm going to give you some of the highlights from the study, some of the key takeaways, and then we're going to have three great panels. We're going to have a group of people speaking about the equity, a debt panel, and then also an operator panel. And the idea here is to get a conversation going and started about how we can address housing and care needs for middle-income Americans. It's this huge cohort, and we need to address it, because if we don't address it, the government can't afford to pay for all these people that are coming down the pike. So I think it presents a really good opportunity for all of us in this room to be innovative and come up with new ideas and new strategies and get a discussion going. And my hope is that in 5 years from now, if we get together again, we'll have a lot of really good success stories that we can talk about. So I think we're going to see a lot of models thrown out there, financial structure models, operating models, and at least a few of those will stick. And from that, then we can build and have success, much like what we saw happen in seniors housing 15 to 20 years ago. So I'm going to give us an executive summary. I'm going to give a little bit of background about the study, how big is the opportunity, financial means of the future middle-income seniors, how much can they afford, what their care needs are, what their demographics look like, because they're going to be different than the demographics of today's seniors, And then a few little limitations, just a few limitations of the study, but things that we wanted to call our attention to, and then next steps. So again, what I really want to hope that starts to just happen today is that we talk about innovative financial structures and operating models, because we need those to provide the housing and care options that we have for America's middle-income seniors. So this investment opportunity is big. There's over 14 million middle-income seniors that we project to exist by 2029. That's 6 million more than today. In 2029, so today's baby boomer, who was born in 1946, is 73. In 10 years' time, they'll just be 83. And 83 is the beginning age of when you move into seniors housing. So that's just the beginning. So we're taking it out to 2029, but if you went out to 2039, that 14 million I'm talking about would be much bigger than that 14 million, a lot more than just 6 million more than today. So this is an issue that's going to just get larger and larger as we go forward. Of those 6.6 million, we expect that about 46% will have the financial means to be able to go into today's senior housing models. If we could reduce that cost of what we're estimating at $60,000 a year, so we're assuming there's a $5,000 a year out-of-pocket medical expense and $55,000 a year for assisted living rents, which would be about $4,600 a month. If we can drop that by $10,000, we'd get an additional 2.3 million people that could then move into this kind of middle-income senior housing. And at today's utilization rate, which is about 11.2% penetration rate, we expect that there'd be a need for over 700,000 units of seniors housing by 2029 to satisfy that demand. And if I translate that into what the current pace of construction is, that would take about 17 years to create that amount of housing for this middle-income cohort. Now, just to put into context, the middle-income seniors cohort, think about the workforce housing that we see in multifamily. This is that same cohort of people. These are the teachers and the firefighters and the government workers and nurses. We estimate that their annual financial resource is between 25,000 and this says 95,000. But if I did a narrower group, the 75 to 84-year-olds, that band even gets more narrow to about $24,000 to $75,000. And I don't know if that sounds like a lot or not, but that's not just income. That's financial resources. So that includes other forms of wealth as well as their income. We'll get more into that in a minute. We find that when we look forward, future seniors are much more racially and ethnically diverse. They're more educated than today. And that potentially can alter the needs and the care preferences of this big cohort. We found that many of this group have health and mobility needs that will cause them to leave their home. 60% of this group will have mobility needs. Lower marriage rate, fewer children are going to make the option of staying at home less probable in 2029 than it is today because of the higher divorce rates and the fact that people just have fewer numbers of children. So those are the key points that you can take away. As background, Judy Marcheski, right over here, she challenged us a few years ago to really look at this middle-income cohort. And based on her challenge and some of the others that we got from other people who are involved with NIC, we decided to take that challenge. And we work with NORC Newark of the University of Chicago. Caroline Pearson is here to represent them, to really do a study to understand what the expected growth in this cohort between 2014 and 2029 would be. How many of them would there be? Who are they? What do the demographics look like? What will their care and what will their housing needs be? And will they have sufficient financial resource to actually assess seniors housing? So as background, middle-income seniors, we're defining those as individuals that don't have sufficient financial resources to live in much of today's seniors housing, but too many resources to be eligible for Medicaid unless they spend down their assets. And this chart demonstrates that. So you have lower income here, largely Medicaid-oriented, middle income, and they either get care right now by family or unpaid caregivers, or they need to spend down and impoverish themselves to become eligible for Medicaid. And then this is the cohort that really most of seniors housing serves today, that higher income, private pay senior housing. The research, as I indicated, was conducted by Newark at the University of Chicago through a grant provided by NIC in 2017, long ago. We already called out our advisory group who's been with us from the beginning and helping us. Every time we got a little further down the stage of getting the study underway, we would pull our advisory group together to get feedback from them to make sure that what we were doing was actually realistic and was based in reality. So that's Kai, Dan, Judy, John Mark, and Bill. And then Chuck already mentioned the staff that's been involved with this project as well. And then Charlene Quinn, who I put her as staff, effectively staff. She was an advisor to us and helped us manage the whole project throughout. So thank you, Charlene. This is the second sort of public launch of the study. The first was done in April. We had a manuscript that was actually published online in April, and then most recently hard copy in May. We had an event that was sponsored by Health Affairs in Washington, so it was oriented more towards policymakers and legislators. And it was a big success. The manuscript you can have access to on our website, www.nic.org/middlemarket. And you can get a copy of that manuscript. And that was quite a process that we did, led by Caroline. Thank you, Caroline. There's a couple of things that we found really unique about the study. One was that if you look at most feasibility studies that are done in senior housing, it's usually done at the household level, and it's usually done household income. So we wanted to get at individual level because then we could look at the healthcare characteristics more specifically. And we didn't want just income, we wanted a broader measure of financial resources. So we were able to do that, and we defined financial resources, then we annuitized it to give us a sense of what the annual total financial resource income would be. We also, often you don't see home equity as part of the formula for figuring out financial resources for seniors. So we also did home equity, and we separated that from the overall financial resource measure. We also then added the out-of-pocket medical costs. That hadn't been done either. So we are assuming right now a $5,000 out-of-pocket medical costs. As part of this, we made assumptions. So we made assumptions about the $55,000 in rent. We made assumptions about the out-of-pocket medical costs. But we knew that those might not feel comfortable to everybody. So we have an interactive tool that you'll see featured in the windows in those iPads, where you can play with those assumptions to see what portion of middle income can actually afford seniors housing and out-of-pocket medical costs if you change those assumptions. And I'll show that in a little minute. But you also have access to that on our website as well. So the goal of today's event really is, as I indicated, is just to get the conversation started, to see how we collectively as an industry can really start to address the care and housing needs of this cohort. Are there private sector solutions that exist today? What do today's financial structures work for middle market? Does today's operating model work? And maybe we need public-private partnerships, and what form do they take? So after I give my remarks, as I said, we're going to have panels that are going to talk about these topics. So how big is the opportunity? So first, let me describe that when we looked at the group of middle-income seniors, we broke off middle income to be the 41st to the 80th percentiles of the financial resource measure. And that gave us these numbers here of a range of $25,000 to $74,000 for 75 to 84-year-olds, and $24,000 to $95,000 for 85 plus. And there are a variety of factors that are going to cause that cohort to swell and to get larger over time. Just the sheer demographics. Most of you have seen that slide that we showed, that the number of births and how that explodes as we hit the baby boomers in 10 years' time. Well, that's causing this big shift, of course, in what we're seeing in middle-income seniors as well. We also know that there's reduced retirement savings, and pensions are becoming a lot less common, replaced by 401k and other defined contribution plans. Changing marital status, because people are more likely to be divorced or more likely to have fewer children, there's fewer family caregivers to go around to take care of all the seniors. Now, this is the size of the group. So this is looking at between 2014, and we chose 2014 here because we were using data from the Health and Retirement Survey, and that was based in 2014. So everything is based here on 2014, just for perspective. So looking between 2014 and 2029, we go from 7.9 million middle-income seniors to 14.4, big significant change. The largest growth is in the younger cohorts of 75 to 84, again, just based on what the birth rates were in the 1930s. But there's significant demand here. So we have almost a doubling of the number of middle market seniors. So what are the financial resources of these middle market seniors? Again, we looked at not just income, but also assets. So assets would be vehicles, real estate, IRAs, stocks, and securities. And then separate from that, we have home equity. We assume that the combined cost of assisted living, housing, and medical care, again, is at $60,000. That's probably at the low end of anything of out-of-pocket medical costs and rents, because we're assuming that there's a minimal level of care that's provided for assisted living. And we know that the longer you stay in assisted living, the higher is the care fees that you're paying. So in any case, that makes this probably a conservative estimate. And we know that the definition of middle income is set to sort of safely exclude people who may be eligible for Medicaid, but many low-income seniors that are in our middle income group may not qualify for Medicaid as well. So this chart, so what I'm showing you now is available on the website, but this is a select number of charts from our bigger review, what we call our chart pack, and that's 2 or 3 times the length of this. In this chart in particular, you'll see a lot in the chart pack, because it's meant to illustrate how many people can afford or not afford seniors housing. So let me spend a minute on it. So on this scale is the actual number of seniors, but in millions. Over here are the income, and the blue represents income without home equity, and the green represents income with home equity. So the first group here is 24,000 to 30,000, and then it goes up by 10,000 groups. 30,000 to 40, 40 to 50, 50,000. So when you look at this, if we assume a $60,000 out-of-pocket costs and rent, that $60,000 would be right here. So all these people over here can afford seniors housing. Conversely, all these can't afford seniors housing. So at a $60,000 threshold with housing equity, 6.6 million of that group, or 46%, can afford seniors housing today as it currently exists. If I don't include home equity, it shrinks dramatically to about 19% that have the financial resources to be able to afford seniors housing. And again, depending on whether you look at the glass as half full or half empty, that 46 becomes 54. 54% don't have the means to do that. So when we were in DC, we talked a lot about that 54%, that we need new solutions for that 54%. With this group, we have 46% that can afford today's senior product as it is, but there is still that 54 that can't. So we do need to come up with solutions to serve that group as well. So this chart illustrates that if we were to try to reduce those costs from that $60,000 base to, we'll say, by $10,000 to $50,000, we would get an additional 2.3 million people that could afford it, or 8.9 million of the 14.4. So that's a significant portion. So that's incentivizing us to try to figure out a less expensive way to provide housing for the middle income. And that's one of the things we'll be talking about in a minute. We can look at it another way. This is the same information, it's just displayed differently. If this is a $60,000 fee right here, you can see what portion of individuals can do it with income and how much do they need to draw down on their assets, and then do they need to draw down on their equity. So in this case, the cohort that's the 81st to 100th would need to use all of their income, a good portion of their annuitized assets, but they don't have to use their home equity at all. When you get up to a $45,000 fee, you can see that people would use their income, the annuitized assets, and then they have to use a little bit of their home equity. And this group would have to use even more of their home equity. So we have that ability to play with these numbers, to look at how much they would have to draw down on their assets and who can really afford seniors housing. Now for developers in the room, we took that analysis and took it a step further and said, here's that $60,000 fee. That translates into that 6.6 million number of people, 46%. I used the run rate of how much construction is going on at the national level for 2018, and I estimated that to create the number of housing units of 739,000, it would take us about 17 years to create that. Said another way, at an 11% penetration rate, which is the penetration rate we have today, we would need 739,000 units. And that, again, would take us 17 years to build if we did today. If we changed the sensitivity at all and dropped it to 50,000, we would need over 1 million units. If we were able to get it down to 45,000, 1.1 million units would be required. So, and if we were able to increase the penetration rate, even at the 60,000, we would get up to 1 million units. So the point is that there's a lot of product that's needed to serve this group. And you can play around with these numbers yourself to sort of get a sense of the sensitivity on it. So that gives us a sense of how big the cohort is, what their financial resources are. Now let's take a look at what their care needs are, because this is one of the first studies that actually looks at the size of the group, their income characteristics, and their care needs. So this is a good summary chart of that. So there's that 14.4 million seniors. 9.6 million, or 67%, will have 3 or more chronic conditions. ADLs, 91% will have ADLs, activities of daily living. 8% cognitive impairment. 60% with mobility limitations. Mobility limitations and cognitive impairment, 6%. And high needs, 20%. And high needs here is defined by people with 3 or more chronic conditions or 1 or more limitation in an ADL. So this is telling us that not only is this cohort big, but it's big and it's going to have a lot of needs. So as we look forward, 60% have mobility issues. As we look forward, that helps to define what types of construction and what types of projects, what types of design features we need in some of these properties. If I look at the 85 plus cohort on here, the high needs group goes up to 33%. So that makes sense. You know, the older you get, the more needs you have. But we were able to break that down into those 2 cohorts. These next few slides just demonstrate those same points. So limitations in activities of daily living, they're, as I said, more common as you get over 85. And you can see that here. I don't know if you probably can't see that there, but roughly 17% of seniors age 85 and older will have some type of an ADL need. Let me see. Cognitive impairment. We expect that cognitive impairment, as I said, gets increasingly more prevalent as individuals age. So roughly 500,000 seniors over 85 are going to have cognitive impairment issues by the time we get to 2029. High needs continue to grow as well. And you can see that 16% of seniors between the ages of 75 and 84 are projected to have high needs in 2029. 33% if you look at the seniors who are over 85. So who are these people? They're changing, as I said, the demographics change. So women will comprise 58% of the 75 plus cohort, up from 56% today. We were kind of surprised by that finding, actually. We had thought it would go down, but it's increasing. So you can see that here, 58%. Seniors are becoming much more diverse, with a significant increase in both blacks and Hispanics over 75. And that's demonstrated in this chart up here. That minorities are going to become more common, rising to 16% from 9% in 2014. This chart shows that again. You can see the racial mix changes, 9% to 16%. No high school diploma. Only 3% of seniors in 2029 will not have a high school diploma. That has implications in terms of income, because as you get more educated, your income goes up, and it feeds through into our numbers of the middle-income seniors. Married, dropping from 61% to 52%, which speaks again to the need for outside care because you won't have a spouse there to take care of you. And this is the same thing on college education. we go from 1 in 4 to more than 1 in 3 people who will have a college education. So there are some limitations to the study that I just wanted to call attention to that we thought about extensively when we were putting the study together, but we had to make some assumptions. So let me point that out. So we assume that the rate of health conditions, chronic conditions, mobility limitations continue at today's rates. We know we're going to live longer. Are we going to live longer healthier or live longer less healthy? So we weren't comfortable in making that decision, so we decided to keep today's rates as is. And to the extent that these conditions will become more or less common, the estimates are going to be affected. The growth rates for financial resources. This is all done in 2014 dollars. So it assumes that we use the 2014 financial resources of the people who will be seniors in 2029, including their actual rates of savings and ownership and retirement plans. And again, we assume that the rate of change in incomes and assets would match the historical trend for the next 15 years. So that's a big assumption. We're assuming that how things grew in the past will be how they'll grow in the future, which probably isn't the case, but that's the best we could do for an assumption. In this study, we did not assume any contribution from the adult child. We've done some surveys with some of our committees within NIC, and we couldn't get a conclusive answer in terms of what the share of adult contribution was. So we put that aside. So to the extent that they actually do contribute, that would alter these results as well. We assume that there's no inheritance that you get as a senior from in the future. From, let's say you're 75, you're 80 years old, and your parent dies and you get inheritance. We're not assuming that. We are assuming, however, that if your spouse dies, that you do get that income source. And as I said, we're assuming that home equity is a little bit put on the side, but we do take that into account in looking at our analysis of with and without home equity. But we do realize that home equity isn't always going to be drawn down entirely. We do know that people want to keep some portion of their nest egg aside, so they won't draw down the entire thing. So to the extent that we're drawing down in our charts, home equity, that's probably a little bit over simplification. For assisted living, we're assuming that asking rents include a minimum amount of care. And we know that in time, that asking rents actually go up, or the care fees go up over time as our residents stay in place. And we're also making an assumption about the national rates. We haven't brought this down to the regional level. Caroline's going to talk about that in a minute, so we'll talk more about that. And then the out-of-pocket medical cost assumptions, we assumed $5,000. Our interactive tool allows you to bring it up to $10,000. And there is evidence that it might be more than the $10,000, so we might be conservative on that. Let's see. And the study sizes the entire middle-income seniors population and estimates their health and their mobility needs. Again, to the extent that people actually enter seniors housing, that will have an effect on that. And finally, the life expectancy, we put this in here because we annuitized the assets. So people were wondering, what does that actually translate into the number of years that we're assuming? And this down here shows that for women, we're assuming at 85 plus is a 5.6 years. That's what the actuarial tables are telling us. So next steps. Today, we're focusing on the private sector innovation. In the future discussions, we'll be talking about public policy innovations together. So with that, I'm going to call it quits. I'm going to bring Caroline up, and she'll talk about, this is Caroline Pearson, sorry. We're like joined at the hip now.
We are.
She's from Newark at the University of Chicago. She has been really instrumental in helping us pull this all together. And one of the questions I knew that you were all going to ask us is, okay, you guys did this at the national level. What about the regional level? So Caroline's here to talk about that. Great. Do you need? Oh, you don't have it.
Yeah. Well, first of all, I want to say thank you to Beth. You've been a wonderful partner. I don't know who's going to email me tomorrow. I'm going to be so lonely. And thank you to Bob Kramer and NIC. It's been a long but wonderful project. I was fortunate to be at the Health Affairs event last month and be presenting, and I have to say I was really in awe of the response that we got from the policy community to the research. I've released a lot of research. People are always very kind and gracious and say thank you. But the excitement in the room was palpable. And we had lots of people asking about what can we do next with this, right? You've created real value. How can we continue to use this model to answer new and different questions? So we had people from various disease groups saying, do you know what the specific chronic conditions are? Can you help us understand what my patient population is going to be in the future? And the answer to that is yes, we do know that. We had people saying, I'm really worried about that spend down, right? Can we start to model what the burden to Medicaid would be if we don't solve this problem? And the answer is yes, we can do that. We had multiple graduate programs saying, can we have the analytic files because all of our students want to do analysis? And the answer is yes, we will make them available, and there's a place on the website that you can request them. But policymakers, we love national data, we love big numbers. That's what drives Washington. But for you all, none of you are building national investments here, right? All of your investments are going to be local, and any given senior's decision about where to move into as a future residence is going to be a local decision. So, the question is, we can say average national rents are assumed to be $55,000 a year, but that doesn't tell you very much about what it's going to cost for my mother-in-law, who lives in Gainesville, Florida. In Gainesville, Florida, as it turns out, the national average annual cost is closer to $45,000 a year, so she's on the lower end. But if she wanted to move closer to my husband and I in Chicago, she'd pay 25% more than that. And if she wanted to move closer to my brother-in-law, I don't know why she would want to do that, here in New York City, she'd pay about 50% more than that. And so I think the next step that Beth has really challenged us on is to say, can we look at an MSA level and begin to bring this model down a level to say, how many people are we going to have in that area, right, who would be potentially eligible to live in a community like this? And most importantly, what are their health and financial needs going to be? And so, we've started to think about that because, of course, from an investment perspective, Gainesville is wonderful. I think there's about 20,000 seniors there over 65, fewer over 75, and not very many 85-year-old plus. There's 40 times that many in Chicago. So, of course, as you guys all know, local markets matter. We have a couple of ways that we can do this methodologically. There is the really good NORC way on small area estimation, which I'll talk a little bit about. And then there is a little bit more of the back of the envelope way, which I think can still be really important for decision making for folks in this room. So what we've done is built this big regression model where we look at the real attributes of the real people in 2014 who will be 75 and above in 2029. We know what their age, gender, race is going to be, and we know how much they've saved for their future retirement. And what we've done then is created a regression model to project them forward on the basis of each of those small demographic attributes. So your race and your age is likely to affect both your life expectancy, but also what your financial makeup is going to be, right? So we're able to create this model with these attributes and understand how demographics affect savings. And then what we can do is, if you've got a specific region of the country that you're interested in, we can look at which of the variables are most predictive in the model. So is it more important, how much is race versus age versus whether you lived in California or Illinois to your savings profile? And then we begin to match and try and make the population variables match the area that you're interested in. So if we're looking at Chicago, we can rebalance the model to match the demographic mix of the seniors that actually live in Chicago. And that's going to flow through, and it's going to tell you things and the educational attributes of people who live in Chicago versus people who live in New York. And what that's going to do is it's going to adjust the model, it's going to adjust the output, and it's going to tell you, well, people in Chicago tend to have the following resources. and we can estimate about how many of them there are and how affordable housing options at different levels are going to be. So we basically take that national model and we sort of calibrate it to your local region. It gives you pretty good estimates. It's a heck of a lot better than taking our numbers and multiplying by the percentage that Chicago represents of the country, which is what I told my colleagues most of you would do when you went home. So we can do better than that. And then if that's not good enough, then I have some really good geeky Norc dorks who would love to help you on small area estimation. That's a more robust statistical method where you actually, we take the fundamentals of what we know is important in this model, but you really rebuild the model from the local area up, where all of the model covariates are going to be built based on that specific region. So one is sort of a national model calibrated to a local area. The other is a local model from the ground up. Both are good depending on sort of what level of precision you're looking for. But would love to talk about that, would love to sort of help you guys think about that. And most importantly, I'm eager to hear the discussion today. I've gotten lots of questions from press and lots of people have said to me, you've convinced us this is a really big problem. And now we're really scared, what should we do about it? And I said, talk to the investors. So please, I'll turn it back to Beth and let her welcome our panels to the stage.
Okay, so first up, we have our equity panel. So again, we have 3 different perspectives to share today about how to address this. So our equity perspective featuring Pam Herbst from AEW Capital Management and Andrew Brett from NEPC. They're going to join us. Following this, we're going to slide right into the debt panel, and then after that, the operator perspective. So thank you both for joining us. Do you want to give a little bit of bio? The bios of all the speakers are in here, but maybe you can give a brief update, starting with you, Pam, on who you are.
Sure.
Why you're here.
So I'm Pam Herbst. Thanks for having me today. I work with AEW Capital Management, which is a global investment advisor. I have been with them my entire career. I run their direct investment business, which is all of our core and value-added investing across all property types, including senior housing. Senior housing is near and dear to my heart because Beth used to work with me, and it is a sector that we actually analyzed on behalf of the company back in the late 90s. Our opportunity fund had invested in an operating company. We actually were looking at it, not so much because we had a passion for senior housing, because we were looking for a strategy that could actually make money for our clients. And so when we first started doing it, it was a product type that was not particularly well accepted. It was considered to be really risky. Clients were really worried about the operating component, the headline risk, particularly if they're a public fund. But our thesis was that as it became more accepted over time and the clients appreciated that there wasn't as much operating risk, that cap rates would come down and they would make a lot of money, which they did. So for our firm, we went from really investing on behalf of two large public funds, and then we started a fund series in 2009. Our expectations really did prove out. We have done around 21,000 units of senior housing. That includes developing, acquiring, repositioning. That's around $5 billion of gross value. And so our strategy over time has been pretty consistent, although as a firm, we are focused very heavily on trying to come up with a more affordable model for senior housing because we think it's an opportunity, number one, but also just as a part of our ESG and just social responsibility, we're trying to figure it out. So that's kind of my background. I think I bring a perspective of client expectations of return kind of across all property types, which is interesting to see how it compares.
Great. I'm Andrew Brett from NEPC. We are an institutional consulting. We're based in Boston. We've got about 375 clients. We across different client types, so public pensions, Taft-Hartley plans, endowments, foundations, healthcare systems, high net worth, and then corporate DB and DC clients. I sit in research. Our team, what we do is we work with our clients on the real estate portfolio. So from portfolio construction, implementation, and pacing to manager underwriting, we try to look from a top-down view in terms of what we think is interesting, and then underwrite managers from a bottoms-up perspective. And so the way we think about senior housing has generally been a late cycle play in terms of where you can take some risk and just the resilience of the underlying cash flows. It's typically something that resonates with our clients on a personal level and makes sense. And you know, there's great data from the, you know, what the boomers are going to be doing. And so we look at it, I'd say, more on a value-add opportunistic basis, generally speaking, but it does seem to be becoming more prevalent from a core plus perspective.
So it's interesting, just to preface it for a second. So we were also supposed to be joined today by John Mark Ramsey, and he can't be here, and he sends his apologies. He had an emergency in his family that he had to deal with. So it's interesting with this panel because these are folks that have been involved in the seniors housing that we traditionally think of private pay seniors housing for a long time. So now we're challenging them to come up with ideas of how they can address the middle market, because clearly it's a different, an entirely different model that has to be developed. So Andrew, starting with you, you advise pension funds on how they should allocate their money. So should they put it in stocks, bonds, real estate, and within real estate, seniors housing? So we're starting with the sort of traditional seniors housing. How do you advise your clients right now in terms of investing in seniors housing? And has that changed in the last 10 years?
Well, it's changed in that we're actually doing it on a more discrete basis, I'd say. So I'd say 10 years ago, we probably were less programmatic in terms of the asset classes we covered and how we deployed capital. Now it's a theme. As I mentioned, when we speak to clients about deploying capital, especially in new closed-end vehicles, without a doubt, typically where we are in the cycle will come up, and folks are just worried about deploying capital at this point in the market. And so when we think about ways to continue deploying capital in some of those more high-returning, higher-risk strategies, we try to think about ways that could insulate some of the risks. And this is an area that we typically do deploy out of the value-add and opportunistic space. And so that type of risk profile, we have been calling it sort of an emerging asset class for a number of years now. And so we're trying to, you know, give it more cachet, I guess, make it more analogous to the main four food groups. With some folks, they think of it that way. With others, they might think it's still not there. And so that's the conversation we have, and it's an active conversation that we're currently having when we're thinking about some of the open-end funds and some of the more yield type of ways to play the asset class.
So it's important, just for perspective, I think, that Andrew represents sort of the consultant to the pension funds, a big institutional capital. So he's the guy that we have to try to really talk to and convince that he wants to go into middle market investing, because then he will tell his client base that they want to do that. If we decide that institutional capital is in fact the source of capital that's needed to serve the middle market, which may or may not be the case. So Pam, I know that you guys started when I was there with 2 separate accounts, and then now you have funds. So you've seen a big shift in attitude towards investors, towards just, let's stay at the sort of private pay seniors housing that we know today, not middle market. You've seen a big shift in that as well with more acceptance, is that right?
Right. So when we first went out to a client about doing a big separate account, just to see how the world's changed, we're actually looking at putting together a portfolio that we could buy stabilized at a 10.5 cap rate. And even with that, our client was scared to death. But I feel like
you guys couldn't see that, but their eyebrows just went.
right. So, but the good news is, after an hour of talking to them, we walked out of the room with $100 million of equity to put together a portfolio, and it ended up doing amazingly well. What we've been able to show our clients over time is that the operating risk that they thought was there isn't as much as they thought, because a lot of them had a perspective that assisted living, dementia care was like the nursing home that they remembered when their grandparents, when they were little, which candidly was how I thought of it too until I became more educated on it. Over time, I would say that the risk perspective the clients has reduced because they saw, particularly through the great financial crisis, that assisted living, because it is need-driven, continued to do pretty well. So even in our own company and my team, I would have asset managers who would come to me and say, oh my gosh, occupancy's gone down from 94 to 88. And I would say, why don't you talk to your colleagues who manage office buildings in New York and every other major metro and find out what's really going on. So we were able to prove out through the financial crisis that the need-driven product really did work, and that we're able to maintain occupancy. We did learn on the independent living side that it was because of choice and people couldn't sell their houses, that had a little bit different risk profile. I think what's happened in the institutional investment community, and Andrew can talk to this better than I can, is that because they've seen the risk come down and because folks like us have been able to show them that we can meet our projected cash flows and returns, that they're getting more comfortable. And so while returns have come down across every property type in real estate, you have a number of institutional clients today that are looking at senior housing as being more of kind of core plus value added, whereas 15 years ago, they looked at it very much as an opportunistic play. And a great example of that is some of the core Odyssey funds are actually doing senior housing within their funds. And so they're benchmarked against the NIC index, and I know that all of us who do senior housing contribute to that index, but the data's still, it's really still too small a sample. But I think the clients are getting more comfortable, which I think is interesting for the middle market, because if clients can start to understand that it is a huge opportunity and there is a huge population of people who need the assisted living component, that if they feel that the demand is there and they can keep the property stabilized, I think the return requirement will comfortably be more in the core to core plus space. So when you go through the numbers, it actually could work. That said, when you take a look at just your ability to deliver middle market product and the sheer cost per unit and the margins, that's one of the areas I think we really have to work on. Because when I take a look, we worked some numbers as part of this panel, and some of the numbers that Beth came up with were $80,000 per unit, and as a company, we're looking at attainable housing, just apartments that are more affordable, because the same issue applies across just the multifamily sector as well. We're actually looking at developing some units in Texas for $140,000 per unit, and of that, $25,000 is land. So even if you take that out, you're at $115,000 a unit, and that's a far cry from the 80. So the cost, it's not an issue just of the returns, it's an issue of the cost and how you're going to be able to really pull it off.
Andrew, do you think that you'll be able to get comfortable with middle market investing, or how do you think we could approach that from your point of view?
Yeah, so I think that clients do buy the resiliency of the asset class, and I think we've moved past that conversation. At the end of the day, especially for public pensions, I think where they deploy a lot of capital, into this space. They've got an actual rate of return. I think Beth just highlighted, or Pam just highlighted a couple good points. I mean, when I am working through this, it's the cost structure of building the asset, and it's the operating margins of running that asset. And I think we'd have to hear a really compelling story about how we can make that work, and then how does it get to that 7.25 that some of those pensions might need to achieve to meet their actuarial rate of return.
Pam, do you think that there is a fully private market solution for this, or do we need a partnership with the public sector?
I've thought a lot about it. I think you're going to need some sort of subsidy, whatever you do. And where I look at it is, I take a look at the cost. We've actually done a shared unit, so 2 bedrooms, shared space, and a bathroom, which is pretty interesting because I think the numbers come out to be around 20 to 25% less than the full market pay units. So if you could take a look at, if you get your demand's going to be much greater. Right now, I think for the most part, we underwrite probably leasing up 6 units a month. Of course, it's market specific, but that's kind of an average, whereas apartments can be 20 to 30 a month. So if we start to feel comfortable based on these numbers that there's going to be a population that's 2 times the current size and you can actually lease it up quicker, that's obviously going to impact your cash flows. But one thought is to actually take a look at more shared rooms, almost like college dorms, where maybe you could have a suite with 4 bedrooms and a bathroom that may have, 2 sinks, 2 toilets with a barrier, and then actually have showers that are more like a dorm, right, is a way to get some of your costs down. Because that's going to make a big difference, I think, just even on your operating costs. You can probably be more efficient with your labor. And it can also help you get your costs down so you have less, what I would call less common space, because I believe senior housing is pretty much 35 to 40% just common area. So to get that down. But the other thought, just with the city and town, is if you're looking at a market rate project, just like I'm in Massachusetts, you have 40B, which is, you can get entitlements pretty quickly if 15 to 20% of your units are targeted to 80 to 120% of median income. So if you could talk cities and towns into giving you additional FAR in your property, so that you're actually, if you do 20 to 25% affordable and they agree to give you 20 to 25% more FAR, then you're eliminating your land basis on that. So that could help, as well as maybe helping with the real estate taxes, with the argument that seniors don't really use the services of a town as much, right? They're not really using your school systems or half of the services that a town provides. So that's one thought just on subsidy.
Do you have any thoughts on that in terms of public-private partnerships that would
Yeah.
take this over then?
No, I was going to ask the question, and with the shared space, I just, part of me thinks, that I was having a similar type of thought process, but then how do you think about folks actually going and living in that space? And that conversation seems rather difficult. I know
Yeah, it's
this is an
interesting.
aside,
So
but-
we've done it in 4 projects throughout New England, and I actually caught up with the asset manager and just said, how is that going with the roommate situation? She said it's going great. In fact, a lot of the people have met people they went to high school with, and they're reconnecting with them, and so it's a little bit like the Golden Girls. And she said they've actually had very few problems, but I think what's really important is that your bedroom space, you would need room for like a chair and a TV. And if you take a look at some nursing homes, right? Some of the nursing homes around are rehab facilities where people go after hospital, hip replacement, whatever. In many cases, they have 3 people in a room, right, with 1 bathroom. So, at some point, you have to say not everybody can afford a Ritz-Carlton, and you get a lot of people who who can only afford an Embassy suite. So I think as a country, we got to get realistic about what's provided. I mean, AEW has built some projects, and fortunately sold them at very nice prices that I would like to live in. They have pools, spas, cocktail lounges. They're like over the top, and I think people just have to get more realistic about what kind of services you're going to provide to these seniors based on their budgets.
Yeah, I think that's a takeaway that we've been talking about for a long time, that seniors housing has to get more like the hotel industry. And there has to be a spectrum of product offerings that are out there. And there are some people that can afford the Ritz, but there are a lot of people that can't, and they need to go into more of the Hotel 6. But that becomes an issue then in terms of labor.
Right.
Because labor accounts for about 60% of the expense load. So that's a challenge for all of us to really figure out. I think that's, when I talk about this to people, that's the biggest challenge that comes back with, what about labor? How do you do that? And I think we're going to hear more, especially from the operator panel, about that in a little bit. So do you think that the capital stack changes for middle-income seniors for that type of project, in terms of the debt and the equity, and maybe if there's a mezz piece in there?
I mean, one thought is that, maybe it becomes less of an institutional product. Maybe it comes more for a retail investor, or because you're going to have a huge number of people turning 65, right, who are looking for fixed income in a world where yields are really low. If you get comfortable that middle market senior housing is going to lease up quickly and stay leased, and even if the return is sub 5, it's not really a bad place to be. So maybe there's a way to come up with a product that's almost like a tax-free municipal for people. So the states are helping out too. And I know one of the questions Beth had asked about opportunity zones, I know enough about opportunity zones to be dangerous. I just know that there's very short periods of time you can invest. But if a state actually came up with an investment vehicle backed by the credit of the facility, and you felt like it was going to stay up and stabilized, even if you offered, a 2.5% to 3% return that was tax-free at a state level, that's a pretty attractive way to finance a project.
It's better than 0% that you get in a bank.
Right, and so you just finance it all with like bonds.
There's also an angle of socially responsible investing that you could do at a retail level. Do you think, Andrew, you could do that at an institutional level? That you could talk to a pension fund and say, well, you're not going to get the double-digit returns that you used to, but you're socially investing, and that's good, and you're actually providing a service to your very constituents.
Yeah, I think it still comes back to that rate of return that they have, to achieve. And, in conversations with a lot of clients, I think a lot of folks are still hung up on doing impact investing and trading returns for that. And, the conversation still revolves around, well, you need to invest on it, on its merits. And, oh, by the way, there's an impact here. And so that's a lot of the conversation. I think the return potential still has to be there. And so, I think the tax benefit type of vehicle is an interesting strategy. I think from an institutional perspective, it would be really tough to bucket this as a fixed income, given that you'd be in an equity position. So I think that would be very challenging. There might be pockets of institutional capital that would be willing to
But if
allocate
I
to
could
something
get
like
a 5 or 6% return, which would be comparable to core
Right.
investing, and if I could prove that the risk profile is not anything worse than you might get in a more traditional core.
Yeah, I mean, that's
You can make that
definitely
case, right?
true in this environment for sure. I think, just core has been much more established as an institutional space, and, that's the outlook today, but it's achieved obviously higher returns over the longer term. So what will that trade-off be in that conversation like?
What's the allocation that you have right now within real estate for your client base, in terms of the whole overall allocation? And then what portion of that would be sort of the senior sector niche? It's pretty small, right?
Yeah, so I mean, I think a lot of our clients have anywhere between 5 and 10%, maybe a little bit higher on the high end of their portfolio in real estate. And then of that, I don't think there's a dedicated allocation within that. I think we think about it more from a risk spectrum, and then we try to pick our subsectors when we're going out into the more opportunistic asset classes. And so we typically do see an allocation to that every couple years at least. And, for folks that are being a little bit more thematic, they like re-upping and they can do that. So it's a lot about what we talk about. It's a good amount of what we underwrite, and then it's a fair amount of what our clients allocate to.
So Pam, if there is one sort of innovative but practical idea that could spur more care and housing for middle-income seniors from your vantage point, what would that be?
I really think it's coming up with shared units. I really do, because I think you have to start looking at it as a per bed cost. And you're going to have to figure, work with somebody who can really sit down and get your costs down. And then you're going to also have to figure out a way of subsidy on the land. And maybe that's where the public-private partnership was. And that's why when I was thinking in terms of if you took a component of market rate facility and required it to be middle market, and you gave additional FAR, which isn't hard for a town to do. At least you're eliminating the land basis.
Can you explain FAR?
Florida area ratio, just how many units I can get on my site. So if I was planning on 100, if they said 25% have to be targeted to middle market, what I would do is say, okay, then give me approval to build 125 units or beds on this site. And if they did that, then essentially the cost of my land associated with those units is zero. And so I do think there's ways you can do that. And you could also talk them into reducing a portion of the real estate taxes on that. Because in a city like New York, a lot of cities have all kinds of tax benefits around affordable units, 421A, where your taxes are like nothing until 10 or 12 years when it rolls out. So I do think there's a lot of things that you can do on the public and private side, and things you can do with the state on the capital structure side that could make it more realistic.
So at AEW, I know you often take parcels of land or you reposition buildings and things. Could you imagine repositioning a mall, like a Class C mall, and putting in seniors housing there?
I actually think it would be interesting. I'm not sure I could convince my colleagues. I know we've looked at like B and C office buildings in the suburbs that, no one wants to invest in the suburbs these days for office buildings unless they're fully amenitized. So you might be able to buy a B or C building in the suburbs for $80 a foot and you could renovate that. I mean, people are renovating older office buildings in the cities quite often now. But on the malls, I think it's interesting because you see a lot of medical use going into malls. And when you think of just the closed nature of a mall and the walking space, they seem like they'd be primed for almost like a renovation, a rehab facility and assisted living in a creative way. But I think we have to just think outside the box on coming up with something that's really different.
Andrew, what's one innovative but practical idea you think that could bring, spur more care and housing options for the middle market seniors?
Well, I mean, this isn't my idea. I think it was your idea in the questions, but I thought having
She likes that answer.
But I mean, I think having a foundation or somebody that, you know, if it's not a pure donation, it's some sort of, you know, below market rate of return that can go into the cap stack. And I mean, I think the FAR ratio is a good point too. And I think you have to smush them all together and
Yeah.
get something that approximates, you know, something that could work for the long-term capital.
Okay, do we have any questions from the audience for these panelists? Come on, has to be a few questions. Kurt?
So first of all, Pam, I'd like to just tell you your instincts are dead on right. We did 16.
Well, thank you. That makes me feel good. I have my son here. I'm glad he heard that. I also hope he takes care of me when I need to be in one of these places.
We did 16 affordable assisted living developments in the 90s
Uh-huh.
using the shared room model.
Yeah.
We had a very innovative operator who brought the idea of women caring for women as they age as
Yep.
a way to create a great environment for that. When we sold that to a large organization, they destroyed it within a year, got rid of it because they couldn't figure out how to operate it. So the operators in the room have a real challenge. As an investor, we underwrote that to a 12 unlevered because we thought that the risk associated with the lower income cohort would be greater and there'd be more volatility on the occupancy side and maybe on the rate side. That didn't turn out to be true. We got consistent cash flows out of those investments. So it's a encouraging note, and I love to see that AEW has a leader who's thinking along these lines, because it did work for us a long time ago. One quick question for both of you. When you think about the premium required for a real estate related operating investment like lodging or senior housing, has the spread narrowed recently? I know it was very large when you first started.
Yeah.
Are we getting close to where multifamily, senior housing, and maybe lodging or other asset classes are viewed as investors as, you know, a small premium to the core food
Yeah, so
groups?
when I took a look at the return on cost for senior housing development, total market rate, it's gone down from probably 10% 3 years ago down to about 8 to 8.5, depending on where you are. So there's still the same almost relative spread to multifamily, because multifamily return on cost, you don't even want to know. A place like California, it's 5.25%, right? So the relative
How's
spread
that
is.
compare to the cap rate?
Well, so in California, 5.25 development return on cost, cap rate would be a sub 4. You know, it's crazy. So the relative spread is still there. But I would say overall, if I look at our client base, their concerns and issues around senior housing are so much less than they were, 15 years ago. And like Beth said, hopefully 5 years you'll come back and you'll have a solution. I really think that if everybody works together, there are ways to do it, even around operating costs.
Okay. Andrew, do you have any comment on Kurt's question?
No.
Okay. Other questions? Yep, Steve. Can you wait for the microphone? Sorry.
If 60% of your operating costs are labor, and making the assumption that the luxury senior housing communities today are going to have the same labor costs as a middle market, in other words, you're not going to pimp on labor on the middle market group, where do you squeeze the extra cost out of? I mean, I just don't know if having 2 to a room or 2, or the college dorm, 4 rooms and a living room kind of suite thing, you know, you still have the same labor costs, correct? Or
If-
do you
if-
model, or do you
well,
model
if
that
you
differently?
If you can be more efficient with how residents are living, you probably can serve more seniors in kind of a generalist model, so people aren't running around as much. You could probably do the same if you had like dorm-type showers where somebody actually was assigned to help people take a shower at certain times of the day. But labor is definitely your biggest issue. It's the one that's, you know, labor costs are going up. There's no employees. That's our biggest challenge right now, is really trying to keep people, our operating partners are having a hard time keeping people because they're getting recruited. But I think there's ways you could possibly make the model more efficient so they could service more people. Taxes is a big part of operating costs, food. I mean, one other thought is, you know, I know in the town I live in, at the subsidized senior facilities, they have Meal on Wheels, which is a state-based program that brings meals into seniors. Maybe you can't have big fancy dining rooms. And so you can eliminate, you know, your costs of labor in the dining room.
And I think there's also ways to think about labor that isn't necessarily paid labor. I think there might be more volunteer labor. There's an idea of using, you know, church groups, or a concept I've been hearing more about pay it forward. So you're retired and you go and you actually volunteer to work in a property, and then you sort of bank that time, and eventually you get to use that for your own self at some point. So I think there's ways to sort of bring out, we have this huge wave of people that are retiring, and what we do know is that more and more retired people want to be engaged. Bob Kramer talks about this a lot, about people wanting to be engaged more with their communities as they retire. So it's possible that if you change the narrative a little bit about who wants to work with people that are 85 years and older, that you might get a group of individuals that could start to lower that expense for labor, that are more on the volunteer side.
I understand the efficiency side, but I think it's a slippery slope if you start decreasing the staffing ratios.
Yeah, I think I think reducing the operating costs is the hardest thing, which is why I think you really have to focus on getting your total cost of development down and trying to get real estate taxes down and trying to come up with more thoughtful ways to deliver some of the services. Because labor it's probably the biggest issue.
Yeah, Ryan.
Just following up on Steve's question, curious, Pam and Andrew, just your perspective. If it happened to be that you just had apartments that's catered to this market, their price point was low enough, maybe it was age restricted, maybe it wasn't, but tapped into this market, in part because there are, as Beth mentions, a third of people that are high needs, 85 plus, but that implies that there's 2/3 that aren't.
Right.
So curious, from a cost of capital cap rate perspective, if you had a product that's filled this solution for that demographic, maybe for the case in this instance, it's age restricted. Curious how you'd think about it from a cap rate perspective.
I think age restricted is like totally different, because it's really not, you're not even providing services. It's really an apartment building for people of a certain age. And so those are trading just like multifamily properties in almost every market. And for the most part, the turn costs are less, because a lot of the people stay longer, and they're actually quite, forgiving on the buildings. They don't trash the apartments and have a lot of pets. So we look at those very consistent with multifamily.
Andrew, is it coming up in your world as well?
I think we're hearing more folks talk about it. I think that's a way that multifamily types of investors are trying to tap into the theme. I think that's absolutely right, though. It's more like specialty multifamily. I wouldn't think that it would necessarily be completely analogous to seniors housing. And just when I think about the motivations for folks to go out and maybe get seniors housing versus that, they seem to be different types of paths.
Okay, we have time for one more question. I know you're all a very inquisitive group. Jerry.
So we seem to be talking about an assisted living model at 60,000 or less of total cost, in terms of the monthly rent. And my question is, but that's really attacking the 83-year-old plus market, or 85-year-old plus. Is there the same analysis you do for more of a semi-service enriched independent living model? Because that's that's the only way I think that, one of the ways that we're going to sort of expand the denominator of potential customers, and maybe I misunderstood it, but because those price points were at the assisted side.
Yeah, we actually did do the analysis for independent living as well with a lower price threshold. And I thought I had the slides here, but they're in the chart pack. But you can also, on the interactive tool, you can see what portion of that group can afford senior housing if you brought it down to a $45,000 price point, which would be the base price we're assuming for independent living.
Okay.
So you can see that.
Thank you.
Okay, well, let's thank our panel here.
Thank you for having me.
Thank you. And next up, we'll bring up the debt panel. Jill? Thanks, ma'am. Yep. Okay, so we're going to keep rolling because we time constrained here. So I'm very happy to introduce this good panel, esteemed panel here. And we just heard an equity perspective, and now we're going to hear a debt perspective. So let me have each of you panelists introduce yourselves, and then Bob will have you come up. So start with Christopher.
Hi, I'm Christopher Callahan. I lead M&T Bank's healthcare banking efforts. We have a key focus on seniors housing, skilled nursing in that portfolio, largely in the Northeast geography from Virginia up through Boston. And I'm delighted to be here. Thank you for having me.
Thank you for coming.
I'm Mike Patterson. I work for Freddie Mac. I'm lead the underwriting and credit area that works on seniors housing properties, and look forward to talking about
Okay.
this.
Heidi?
Heidi Bernay. I've been financing senior housing properties for 18 years. I work for Newmark Knight, and we have an investment sales platform and a debt platform, and our bread and butter is Fannie and Freddie financing, so I work with this quite a bit.
Great. I'm Bob White. I'm the president and founder of Real Capital Analytics. We track the capital markets for commercial property. And
with that, Bob's has kindly pulled all his data together to show us a profile of who today is the debt providers to the seniors housing world. So I think this is data that most of you probably have not seen, and I think it's pretty informative and helpful.
great. Well, thank you. And I want to, RCA and NIC have had a partnership for over a decade that's been very rewarding, I think, for both of us. Congratulations on this benchmark study. I think it's fantastic, and hopefully will help transform the industry. So I'll share with you some of our data on kind of the debt capital and how that, for seniors housing, and how that relates and sometimes doesn't to the greater marketplace. So first graph I have shows the composition of the lenders for senior housing and care, actually over a relatively long time period, from 2005 to 2018. Just to give you a quick, you'll see a number of these bars, so I'll explain some of the colors. So the orange bars are the banking sector. So the lightest is the regional banks, in the middle is the national banks, the darkest are international banks. Going to the bottom, the dark blue is the CMBS, the securitized debt marketplace. There's a small teal color that pops up, but it's an important sector we'll talk about, which is the financial fund sector. And then the royal blue, which if you look at 2009 was the majority of the lending, are the agencies. So that's primarily Freddie and Fannie, but it would also include HUD. It would also include some state and local agencies in that as well. But again, primarily Fannie and Freddie.
Do you want the thing?
Oh, sure.
The laser pointer?
I think so. Oh, that would be helpful. Make sure I don't, there we go. So as you can see, over this period of time, there's been a great transition of capital. Like the rest of the market before the market crash and at the end of 2007 and 2008, very much reliance on the CMBS marketplace. In the modern era, very little. There have been some large portfolios, some single issuer deals, none in the past couple of years that have been financed. But seniors housing has not been a part of many of the fusion deals in CMBS. I'm not sure exactly why that is. I will say that multifamily in general is underrepresented in CMBS, oftentimes because it's not competitive with some of the other lenders out there. As I mentioned, when the market dried up after the financial crisis, it was the agencies that carried all of multifamily, including senior housing, through. And at its peak, the agencies were 82%. Even into 2011, they were more than half of all originations. Now, this is conventional financing. This is acquisitions and refinancing loans. And then we get more into the modern era here. Last year, this is our 2018 data, is actually the highest proportion ever of the banking sector as lenders in senior housing and care. And the largest piece of that was the regional banks, about 20%, 17% for the national banks. And the national banks are a big sector, but it's actually relatively few banks that comprise that sector. I'd say less than a dozen. And then the agencies are still a significant portion at 40%. And then finally we get this 12%, which is what we call the financial/fund sector. So it used to be a lot of finance companies in the early days. Increasingly, these are the institutional debt funds that have proliferated over the past few years. And they've become a material part in the senior housing care sector and maybe an interesting component of the capital stack going forward as well. Now, when we look at seniors housing and care, this is, again, just conventional financing. This is for 2018, and it compares kind of the garden, mid-high-rise apartments, student housing, and then senior housing and care is at the bottom. So just to show you kind of the differences in the composition of capital. So senior housing and care has 41% of originations were agencies compared to 66% in the garden sector. I would kind of read the garden versus mid-high-rise as urban versus suburban. In the urban sector, it's probably the greatest competition among lenders for assets in the rental space, and the greatest diversity of capital and the lowest proportion of agency lending. But here you can see even within the multifamily sector, the banking sector has still the greatest proportion of lending. And these funds, which are 12%. Now, these funds are largely sponsored by big institutional investors, whether they're equity funds or institutional advisors. I guess AEW has a fund, like many others. They're very astute investors, and typically that capital has been following some of their equity investments and going to more areas where they perceive that there is a little bit of an arbitrage, higher return given the risk. And that's why I think we're seeing that in senior housing beyond the other property types. What I didn't include in here, and something that's important, is many lenders look at senior housing. Of course, I think we all in this room understand the difference that senior housing has an operating component compared to the rest of multifamily. And so many lenders, kind of a knee-jerk reaction, include it more like a hotel. And that's something that I think, education, and Nick will have a part to play to kind of change that myth, and we'll talk about some default rates. So I'm going to flip this shortly. This is conventional financing for refis and acquisitions. Before I do, I will say this is mortgages, so it does not include some of the balance or the lending that the REITs are getting on an unsecured basis. Some of the big REITs in this space have access to even cheaper capital. It's significant capital that's unsecured through the bond markets. And when I flip this, I'm going to show you the construction financing, which shows you even greater differences. First, the whole sector is much more reliant on local and regional banks and the national banks for construction financing. But then when you look at senior housing, it is almost totally reliant on national banks and regional banks. Regional banks are about 6,000 regional banks around the globe. I didn't run my numbers to see how many were active in senior housing. My guess is relatively few, and that's something that we can do going forward is education among all those regional banks, about the industry and lending. What's absent is the agencies. Even the local and regional authorities have not been very active in financing senior housing, which is something that probably should change if we're talking about middle market housing. So that is, something that the industry is very reliant on one sector just for the construction. And when you saw the numbers that Beth was showing earlier about how much new construction needs to have occur to meet the upcoming demand, this is a very important factor. We took the numbers and we looked at it a number of different ways. We looked at it regional, we looked at size cuts. It was very similar. One difference that we did find is when we looked at it by market tiers. So the major metros are the international gateways, Boston, New York, Chicago, San Francisco, and Los Angeles. Also the most expensive markets. But that's where you have the greatest competition of capital. You have more international banks, quite a bit more of the new debt funds that are active there. And then when you get outside of that, this is, again, just conventional financing I've gone back to, is where the agencies, in fact, in tertiary markets, the agencies nearly have a 50% market share. So as you get to smaller markets, you get fewer options in financing. And finally, I just wanted to show some information that we've collected on losses and default rates. So this is actually just our default rate, our accumulated defaults distress in the senior housing marketplace. So we track this, we've been tracking it for a long time. And after the markets collapsed in 2008, by about 2011, we had tracked about $300 billion of distress among commercial mortgages throughout the nation. Senior housing was less than $3 billion of that, so very, very small. The default rates were minimal. They were, very, very few. You can hardly see this color here, which is how much REO there was in the space. You can see this gray here is resolved property. So, things would become troubled and get resolved very quickly. Very few went into REO. A number of, you can see here, a lot of maturity defaults that occurred in that time period, that were extended. So the sector has had very little distress, and even the loss upon default has averaged only 20 to 25%, which is comparable to the multifamily industry, but considerably lower than other property types, especially when people are benchmarking, if they are benchmarking senior housing to hotels, which is a misconception I do think some lenders have, because hotels had the highest default rate, I'm talking in the teens, and the highest loss rates as well. And I think people blame that somewhat on the operating component. So this is something I think we need to keep track of, loss rates and defaults in this sector. It's particularly important because of some new regulatory environment in the banks, the CCARs and the capital withholding, and potentially we could get cheaper debt for seniors housing if we can show that the default and loss upon default are far less than industry standards. So with that, Beth, I will turn it back over to y'all.
Great, thank you. All right, so Mike, I'm going to start with you. You saw that you're a big player on this capital on the debt side for seniors housing.
One of a couple, yes.
So tell us a little bit about what your experience has been with seniors housing, and then what your viewpoint is on debt provision for a middle market.
We've had a active program of purchasing seniors housing mortgages, independent living and assisted living, memory care, and seniors aged apartments for 18 years or so now, and we have dedicated people that take care of that, and we have built a pretty good business. I think we made over 200 mortgages last year, purchased over 200 mortgages last year. We were able to sell them into our securities and securitize them and match them with investors for our bonds. So we think that it's a very good business line for us. We think that the industry is growing and profitable and stable and provides a very durable income stream. And so with all that, we work through a number of our sellers. We have over 12 of them who have licenses to work with seniors housing mortgages for us, and they're the ones that really get the opportunity to find them and understand them and work with their operators and their borrowers and help us understand what the properties are like.
So Heidi, can you explain that to the audience if they don't quite understand the relationship?
Yes, so lenders like Newmark or Seller Services, how many do you have?
We have 12 that
12.
have licenses for seniors housing.
Yeah, and so we originate the loans and service loans throughout the term of the deal on behalf of the client as well as Freddie Mac and Fannie Mae. Mike's modest. I mean, they've funded in 18 years $20 billion of financing, right, for senior housing, which is a huge number with minimal to no losses. I mean, $2 million in losses or some number that's really low. I don't know. I don't know what you call defaults, but losses have been insignificant in our space.
Yes,
So
they
it's
have.
awesome.
They have.
So do you think that same model can be worked for middle income?
Yes, I do. I mean, we're making mortgages on durable cash flows, right, on well-managed and operated properties. So if they have a larger cash flow come through, then we can work with that. If they have your slide indicates that, your study indicates that they'd have less ability to pay rent, but it would still be a steady and ongoing, stable cash flow with an well-operated property. So I do think that we would continue with the way we are making loans now.
So you feel like you could be able to securitize that group of mortgages to some pool of investors?
We have obviously been able to so far, and I think we are very much wanting to continue to do that. We think that this is a big part of those securitizations, and a strong part of those securitizations. The best thing about the securitizations, I've been lending on apartments and other buildings for almost 35 years, and the best thing about this compared to my earlier career when we basically would stuff it in a portfolio somewhere is now that with the securitizations, you're able to see the mortgages perform on a monthly basis, and so that education ability to different investors, I think, is one of the biggest parts that we bring, biggest innovations that we bring. And so there are more and more people who have the opportunity to see the mortgages as they perform through those securities, whereas before they were just stuffed in a portfolio and very few people got to see how they performed. So I think that's been a big part, and we're going to we'll continue, we look forward to continuing to add to that. It should make it an easier opportunity in the future as people see the mortgages perform and then come back and ask for more.
I was going to say, I mean, just like we have green investors today, right? I would
Yes.
think that this product would attract a certain type of investor that have a social mission as well. So, I mean, that's been huge for Freddie Mac. As we approach green deals, those deals become, when you talk about lowering costs, we're lowering spreads as a result of the investor pool that's interested and attracted to that type of product. So I think that this affordable product will have a similar type of investor pool.
Is that investor pool, is that institutional investor pool, retail investor pool? Who is that investor pool? Can anybody here do that, or is it all institutional?
I get an opportunity to work on the underwriting side, so some of the questions are going to get kind of far, but we have an active business in this. We issue in the neighborhood of more than 50 securities a year, and some of them have seniors housing mortgages in them, and you can access them either by talking to our firm or to one of the lead banks that bring out the securities every week. But there are a number of people who have invested in them. The book of business grows each year.
Okay. Christopher, so do you do more on the construction side or more on the acquisition and refinances?
Yeah, so probably Probably 80% of our business right now is construction. And so in listening to the conversation about cost, we can underwrite to a lower margin for permanent debt and get comfortable with sustainable cash flows. The lower to moderate income seniors housing has margins that are half of high ed seniors housing, but you can still underwrite those cash flows. So we've had some acquisition, repositioning of buildings. We've had some assisted living program in New York, which is Medicaid funded assisted living, and quite comfortable with those as permanent options as well as placing those into the agencies. The challenge is, where does the equity and cash come for a construction? So how do you develop a brand new out-of-the-box facility, or put equity into converting a facility? And if you look at the returns and ability to take cash out at those low margins, it's really a challenge for the institutional market to get their returns that they have over a 5-year period, if that's the fund model that they have.
So do you think that when you look forward into like middle market, would that be an area that you would consider providing debt into?
Yeah, we have done that. We've done low income properties. We've done high-end properties and tax-exempt scenarios where they fall under a regional tax advantage, whether it's 80-20, it's moderate income if it's below the median income in a community. That might still be a very expensive facility with high-income seniors relative to what we're talking about. So there's a lot of models and a lot of ways to finance it. And we can underwrite the sustainable cash flows. Again, the challenge is, how do you build something new in some of these markets?
And scale is an issue. I mean, if we talked about the number of units that would be needed as we go forward, so is there a vehicle that would provide that kind of scale for debt? We can open that to any.
Gosh, I think the debt will be there. I think, we're all capital allocators, and so we're always looking for ways. And if the need is there, and someone says, "I want to build," if it's a good sponsor, and to Kurt's point, a good operator, and someone says, "Look, I want to build $1 billion of this stuff," I can promise you that people on this panel will figure out how to get it done. And so I don't doubt the capital will be there, and it's probably maybe different kind of capital than it is today. Talk about the debt funds. That changes over time. We're lucky enough to, there's more and more liquidity in this space, both debt and equity, and it's better than it's ever been, and that'll continue to get better.
So how do you sound optimistic? So what do you think is the biggest challenge to serve?
Oh gosh, I hate to repeat what everybody else said, but labor and staffing, right? I don't know how to, how that works. But for me as a lender, I think if you get good sponsors, good operators, good product, whether it's a new build or a repurposed, vacant commercial building that's being repurposed for this, I think it's exciting. I think the debt piece would be easy.
You've heard it here. So, Mike, what about you? You also do affordable housing for multifamily.
Yes.
Are there any lessons or any models that we can build off of that would be applicable?
Yes, Freddie Mac's very heavily into both affordable housing and into workforce housing, and in fact we really got into that end of the business a number of years ago and have grown that to be the vast majority of the mortgages that we purchase. I think that's just, we spent the time basically to learn and understand what we were looking at, and I think that's basically what we'll be looking to do here also. So we do quite a bit of acquisition financing. We do a good measure of financing once a property has just become stabilized and just become leased up in full, and it's the opportunity to learn in those areas what's working, whether it's being the shared housing was talked about earlier today, or other types of ways of operating the properties that we'll need to understand in order to help provide more of the financing.
Do you think, this is again open to the whole panel, that the sort of alignment of interests or what you would expect from your sponsors, from your operating partners, would change in terms of what you would be looking for or looking at, in terms of debt service coverage ratios, or what the LTVs would be, or anything like that? Or would it be the same that you think that we have for the
I think it's the
traditional
same.
senior
You know, I
housing?
think it's super important to partner yourself with sponsors who are committed to the space and experience in the space, as well as operators who have a track record. So, you know, if someone came to me as a lender and said, look, I'm going to, whether it's a $20 million one-off or a $1 billion portfolio, and said, I want to do this thing. If there are multifamily folks who don't have experience in the space, I'm not interested. But if they're senior housing folks who have experience, who are committed to the space, that's a different conversation. So I don't think that changes.
Yeah, I think Kurt said it earlier when he talked about some developments in the 90s that really seemed to work well. So the demand is there, and I actually think these facilities will fill pretty strongly if they're built in the right place at the right price point. And how do you give that service? And I actually think about leveraging some of the community-based entities, whether it's Meals on Wheels or trying to provide some Medicare services to add reimbursement above the rent. I think that's a key driver, but to the point is the lenders are going to be there as long as the cash flow looks strong and sustainable. And we actually adjust the values based on a cash flow. We might assign a higher a higher cap rate to a project like that. So it works out in the math to make it loan to value is appropriate.
One thing I'd add is when Heidi and I get a chance to work together, we're basically, one of the biggest things that we're looking at is the potential tenant pool. So, how big is that potential tenant pool in that area to be able for the owners and operators to attract to that particular building. And one of the things that's, you've shown obviously is that tenant pool is going to be huge at a certain dollar number. And so that, the understanding of that and the ability to understand that this property will actually operate well at this price point and this tenant base is big enough to meet there is going to provide the lenders that I work with, to have a lot more comfort around those particular properties and help us to look for the innovation.
So we saw that from Bob's data that the default rates are really low. Why is that with sort of traditional senior housing right now? Is it related to the tenants? Is it related to the operator? Or what's causing that? And do you think that could occur for middle market as well?
Our book of business, it's clear that it's just a very good collection of people who really understand what they're doing and run their businesses very well. It's a collection of individual mortgages. It's not macro type stuff. It's mortgages built one by one, and it's backed by people who are out there working hard every day.
So my take on the risk models is if you look geographically, it's probably different in different spots. So we saw some really strong performance through the downturn, through the crisis in markets, and we saw development come out of that quite robustly in places like Massachusetts, Southern Connecticut, into New Jersey, and central Northern Virginia. Remain strong through the entire period because they have the population and demographics that work. So that kept those markets quite strong, and the losses minimal for us.
Well, it's particularly impressive because we know that the sector itself today is stressed overall in terms of occupancy rates, and in some markets, like in San Antonio, the occupancy rate is in the low 80s. So how do you jive, if you can? This was a question that was posed to me, so I'm going to give it to you guys. So we have, in some cases, an occupancy rate that's showing that the market's overbuilt in certain geographies. Yet I also just showed that there is a significant amount of need, but the need isn't quite here today, or it could be here today for middle market if the middle market isn't served yet today. So how can we get at this as fast as we can without causing even more excess supply and more stress on some of the property performers and business plans? Any thoughts of that? It's sort of a timing issue of how do we build it without causing even more stress in some of the oversupplied markets. Any thoughts on that?
That's a good question. Judy should answer that one.
Well, that's good because that's
That's
good because that needs to go out to the collective, because we know what's going on in the broader market. Yet we're also showing and demonstrating that there's this huge need, but it's a need for a place in the market that's not serving. we're not serving the need today in the product that we're building, I guess is the way to say that. And if we could create the product and the financing and the operating models, and the financial structures to do it, we wouldn't have an 85% occupancy rate. We could bring it up to pretty high. So that's something to think about, I think. So is there any, we've talked a little bit about it, but any singular, innovative, but practical idea that you could think or want to share that you haven't talked about already with our group about how to spur more options for middle market seniors today and in 2029? But how about today? What can we do right now, or at least to throw some ideas out that we can start to debate it? Bob, do you have anything you've been
Well, I
hearing about
think
this?
on the lender side specifically, because I think Nick's been great in the education and helping, the institutional community on the equity side, realizes that legitimate property type has emerged from being, very small and insignificant to a major property type or close to it. I think the debt markets are farther behind. So I think that the more they hear the experiences of the banks and the agencies with their lending platforms, that you don't necessarily need a specialist group to focus on this, or you should build a specialist group because look at the demand that's coming, so that if they don't have that. So I think that, because again, there are, 6,000 regional and local banks, and a relatively small handful, all of them, or almost all of them, are active in real estate lending, but relatively few are active in the senior housing space.
Okay.
Gosh, I think the equity panel covered this pretty well. I mean, I think there's, I'm excited about it. I think folks who are building new purpose-built properties that have shared units, I think that's an awesome idea, as well as repurposing vacant commercial properties, whether it's big box retails or mall conversions or old hotels. Lots of ways to skin the cat. I don't know that there's one way to do it. And the debt will be specific to whether it's new construction or even, Fannie and Freddie have developed a pre-stabilized program for new stuff. And you talked about debt service requirements. They've really lowered that by product type. And, we're doing a lot of pre-stabilized buildings, whether it's new construction that's just leasing up. And so that's exciting, right? It provides a lower level of minimum debt service and permanent, inexpensive, cheap financing on the long term. But I think the debt will be there depending on what gets developed. I mean, that's our job, is to figure it out.
So I'd be interested when we have the operator panel to ask about whether a property has to be purpose-built to serve senior housing, or whether you can actually do the rehab, and
Right.
can you take a mall, or can you take a hotel, or an office building and rehab it so that it's efficient in terms of labor, for example?
We've seen some repurposed hotels that have done well, really well. Yeah.
Mike?
I think you were talking about differences. I think one of the items that's come along in our portfolio, working with our sellers, is that owners have found are more often coming to us with a diverse group of income, so they're having a little bit of each, a little bit in each area, a little bit of independent living, a little bit of assisted living, memory care, and so our mortgages that have a diverse set of income have been growing, and we feel much better on them. And so I think that would also be part of what would be innovative or able to add more properties to this, is to keep an eye on having different parts of income come through.
Are you saying more levels of care?
Yeah, more
provide more, and we did see that in our portfolio, $7 billion book of business, and whether it was 2 levels of care or more, property performance over time was much, much better in our book.
Okay, Christopher?
And to the extent some of that care you're providing can be reimbursable from different sources, whether it's a daycare type option or a rehabilitation type option that you're actually providing in seniors housing. I think seniors are allotted a certain amount of rehab, just being a Medicare patient, like going to the gym and things like that. So how do we manage some of those reimbursement avenues to bring additional revenue in? But I think some real innovation is on the employee and staffing side, because obviously costs are going up, the skill set's not necessarily there, the labor pool seems very tight, and so how do you bring these people in a caring function and train them and grow that? So there's probably some regional initiatives between multiple healthcare providers that can help fill that void.
Great. Okay, we have a few minutes. Questions from the audience? Yeah.
I think one of the things missing with all the respect to the conversation is, the first part is development, right? Sorry, I'll repeat. I think one of the things that's missing in this conversation is the first part is the development, and with all due respect to Freddie and Newmark, they're not doing the development side of the lending, right? As I think Robert just showed, like, agencies are not part of the conversation on the development side. So really it's got to start with, like, today's conversation doesn't have any developers, like bringing down the cost of development, which some of the people on the equity side were talking about. So
The operator panel is going to talk about a little bit
okay,
about that too.
so like modular construction or something else that developers might be looking at to actually bring down the dollars per unit is, I don't know.
So I agree with you,
Yeah.
and probably one of my biggest worries, and I expected a question around that, is how do you get the land, right? So we talk about repurposing a shopping mall, but the people that live in urban areas might not have a repurposable shopping mall or hotel nearby. So how do you acquire land to build 100 or 150 units within 10 miles of Washington, D.C., or New York City, or Chicago? So I think that land cost and development cost is probably the toughest challenge. And since I don't have an answer for it, I didn't really want to talk that much about it.
Well, I know in the operator panel, we will be talking about some of the construction costs and development costs. So, yep.
Just given the newness of the space and, just given the newness of the space and also I think everybody admits lower margin potential, what sort of equity cushion would you be looking for on a new build?
It
eyes on you.
depends on each, the statistics on each facility. But I find it hard to believe that you can't do it below like a 15% equity. Given where it's looking, I think I threw a chart together as we kicked some ideas around. And
Want me to put that up?
Sure. So to get to a rate of like 2,500 or 3,000 a month, who's going to contribute the equity to get that return?
Which one do you want?
Yeah, the third one. Yeah, so if you look at that model, it's a 25% loan to cost, and for a cost that you really can't build right now, it's hard to get your money out in that situation if you're an equity investor, because you're going to be taking a coupon. I'm not going to speak for the private equity folks, but they're looking for a return to be sooner than 10 years or 12 years. In this example, that equity is going to be locked up for a period of time because there isn't cash flow or a sales event to extract it based on the operating model. So the permanent markets are going to play there. And it'll be, my guess is I think it's going to be not-for-profit operators or impact investors. I like that better than social justice, but impact investors coming in to take a different return model, and I'm not sure who that is.
Right, once it's up and running, it's a much easier analysis to lend against. It's getting comfortable on the front end and how much cushion you folks think you'll need on a new build.
So I think a construction lender would lend into that model. And I just don't know that it exists.
I have a question. Is this an actual example? Because I've never seen anything at 80,000 a unit for.
No, it's backed into a rent. Okay. So what can you do for $2,500 a month at 18% margin?
Okay, I'm with you, because most of the construction I see is like, way above that.
Yeah, those are the other examples.
The next one, yeah.
First one.
Yeah, so this is an actual loan in our book, right? So.
I'm just wondering which operators are doing it.
If I was lending at 80,000 a unit, I wouldn't get invited here.
Okay, a few more questions? Come on, your inquisitive group, let's go. Yeah.
Beth, I was really interested in, Robert, some of the information that you put up there. One of the questions that came to mind for me was related to the hotel industry. And in many ways, the hotel industry is something that we look to as leading the way. And I wonder, in terms of debt, if you were to track hotel sources of debt, whether it would give us an indication of where the next pockets are likely to open.
Interesting. That I would do that. CMBS is a much bigger franchise in hotel than many other property types. And you know, the securitized markets are interesting. There's a new aspect of that, the CLOs, collateralized loan obligations, which is a growing piece. We actually, the agency stuff does have securitized much of what they have. We don't show that in our CMBS sector. But, you know, it's a double-edged sword when you compare, you know, debt for hotel versus senior housing because, you know, the default rates on hotels, the expense, you know, hotels are more expensive to finance because of that. And, you know, the uneducated will look at just, oh, it has an operating component. It's like hotels. It should be priced like a hotel. I will say the foreign capital, both debt and equity in this sector is a promising area. You mentioned it with the Koreans. We operate globally, and you know, my travels around the globe and others. You know, first, their attraction to anything multifamily has increased multiple fold over the past cycle, and that had always been a very small sector for them. And then the aging economies like Japan, Korea, especially even China, very, very interested in the senior housing sector in the U.S. As both an investment, but also a template, an experience that they could bring home.
The questions? Okay, with that, thank you very much.
Thank you.
Phyllis. And next up, we're bringing up our operators for an operator perspective. And this is going to be moderated by Kai, so I'll come off the stage.
I think so, yeah. And they get to answer all the questions, so yeah, it's not a bad place to be. Hey, how are you? Seated? Is this on? All right. Thanks, Bob. Everyone, if we could please take a seat, we'll get started.
Very good. That's better. Didn't work. That was better.
Yeah.
They're not even moving.
We need the voice of Bob Kramer.
Yeah.
It's like God has spoken.
Yeah. Bob, we need your voice.
If we could all take a seat, please. $20 for everyone who takes a seat right now. All right, thanks.
They did not include a break in the schedule.
Yeah, that's right. Well, look, we'll go ahead and get started here. If look, it's been a very interesting conversation so far, this morning, and it's been a great to be a part of this, this study here. I think it's this is where the rubber meets the road now, and the question is, can we actually make this middle market operating model work? And we've got some folks up here who have actually already dipped their toes in the water. So I think we're all, excited to hear exactly, what they've done so far. So if you don't mind, maybe you can go left to right, and you could talk about your company, and then also the product that you guys have, created for the middle market. Tom?
Tom Grape from Benchmark Senior Living, based in the Boston area. We have 58 communities in the Northeast, and we too have been recently rolled out several with the shared occupancy model, which I can answer some of the questions that have been talked about, at least the way we've done it, in terms of staffing and construction costs and so on.
I'm Gauri Rodman. I'm with Direct Supply Aptura, and I'm not in the operations business, but we, as you know, are a company that supports the operations and our clients, and we see a wide array of different concepts and ideas that are brought to the marketplace in the entire development spectrum, looking at the development and the operations component. And the thing that excites me also is the innovation and technology component, which will have a potential impact on operations, which is 60% of the cost. So the idea of having a conversation that brings all those components together is what I'm really excited about.
My name is Judy Marcheski, and I'm with Leisure Care. Leisure Care has 50 communities in the U.S. With IL, AL, and memory care in various combinations. Our portfolio ranges from middle market to middle upper market. We just opened our third middle market product in Raleigh, North Carolina. And I'm excited to be here today because I've been working on this task force for a very long time.
Maybe we could start, for Judy and Tom here too. In terms of the middle market, what exactly called you to that place? And as you've thought about it, what were the I guess initial steps that you had to take to go down that path?
Well, we were drawn to it for the reasons that motivated the study, which is we know that we've seen rents and costs just continually increase, and knew that there was an unserved middle that we wanted to see if we could tap into. And so we tried our first community really as an experiment to just sort of dip our toe in the water and see if we could make it work in a way that we were comfortable with. And we've been very pleased with the success. So we've got a couple more getting ready to open, and are intrigued with the progress we've seen so far.
Okay. Judy?
We too looked at what was coming towards us and really wanted to design a product that met our philosophy on senior housing, but was at a more affordable price. And what we did was we looked at, and this is in 2014, so these numbers kind of make sense. We designed the product around what people could afford, and the price that we determined at that point was $2,850 for rent, the rent component only, and that pretty much matches where the middle market turned out to be. And we really started from scratch and said, how do we have to design this, and how do we operate this to stay within that rent price? So really looking at it from the customer perspective rather than the investor perspective.
Okay. And then from, let's start with the money, right? So from a finance standpoint, Like, who did you approach for this, and did you have to do some convincing in order to get it done?
So we just opened our third, and each one has a different equity partner. But the traditional construction and then equity has been, like many of ours, just one for each project.
Okay.
I'd like it, I think that the secret is what we have done is really build an efficient model for operating and for construction. And I really think that the last piece of that is really coming up with the efficient capital structure. That's what's missing in what we have done, is that it isn't efficient yet.
Tom?
We too targeted $50,000 sort of rent number or less per year. So our rents, our average rent in this community for assisted living is about $3,300 a month, which in New England is a pretty good number. Our memory care is a little bit higher. And so that's about 25% roughly less than sort of the market area competitors. And I think we were also able to reduce our staffing by about 15% from what a normal property would be without touching care staffing. So our care levels of staffing are the same. We were able to reduce our overall staffing by 15% by sort of tinkering around the edges, which I'm happy to describe a little bit further.
Yeah.
And our building size is about 25% less than a traditional building. So we were able to do that again largely through the companion units. And I think we too did this with conventional financing. It'd be great to have years ago we did a number of in different properties some low-income tax credit financings. It'd be great to have a financing program like that or some other creative mechanism to marry with this sort of building type to add financing with an operating model to really sort of pack the two together and really help target the middle market more effectively.
Well, maybe you can expand on that a little bit then. So if I were to stack up a pro forma for your middle market product versus a pro forma for your standard product, what are the key differences between the two?
Well, we first of all, we're located in a more blue-collar market, so the land cost was less, number one. Number two, our construction cost was per unit was probably 25% less, and that was, we did do smaller building sizes, I mentioned. And we also, our memory care is on a single floor, our assisted living is 2 floors, they're connected, but we chose to do wood frame construction, which is allowed in Massachusetts. In fact, most assisted living communities in Massachusetts are wood frame. Our otherwise buildings we're doing steel and concrete, but in this particular model, we went with wood frame and the 2-story portion to keep the costs down. And then on the operating side, again, we reduced staffing by about 15%, and it's little things like not having a dining room manager, or reducing the activity staff by half an FTE, or things that were sort of nibbling around the edges, but that, again, we did not touch care staffing levels at all. And because of the smaller building size, actually, the way we marketed this was not as a lower cost option, but as a high sociability option. And when actually we encourage folks to spend more time in the common areas than in their units. And when you walk in this building, the vibe in this building is electric. And so there is since somebody mentioned earlier volunteerism, there is a great sense of volunteerism, not only from, somebody mentioned church groups and so on, but also from the family members and from the residents themselves. And because of the more compact building size, the common areas are sort of, have again a great culture in this building, and it's really worked even with the slightly scaled back staffing in some of the more peripheral areas. There's a little bit less housekeeping, again, like probably half an FTE less in physical plant because the smaller building size. So it's those kinds of things on the staffing side, but again, no impact on care staff.
So are your margins the same as?
Margins are about 5 points less, so a little bit less.
Okay.
Our NOI per unit is a couple of $1,000s less, but we got the same unlevered return on cost. We're getting the same IRRs projected over the whole period, but we're going to slightly lower margin.
Okay. And Judy, on your side?
Fairly similar. We, again, really focused on efficiency, on very thoughtful design that has enabled us to reduce our staffing levels. And it's in the kitchen design, it's in the way the food is delivered, it's in the menu design. So we still have very high quality food, but fewer options, and prepared differently. So prepared throughout the day rather than all at once, which allows a better staffing pattern. So really, it was a long recession. We had a lot of people working on this because we weren't building anything. So we put the whole team to designing this, and really spent a lot of time very thoughtfully designing the building from the inside out. Really focused on operations and not the typical design of looking at the outside and how to make it look pretty and then ending up with what you end up inside. We went the other way, which is where the 180 comes from. We flipped it around and looked at it a little differently.
Right.
But we've really been able to design and operate at significantly less cost. And it's been proven out.
So what is the cost per door, cost per unit difference then?
So I'm not very good at doing math on the fly. So the first one, in 2014 dollars, fully on construction, fill up, all in was 26 million, so less than 200,000
Okay.
a unit.
Compared to your,
We don't have our portfolio has been built up over 40 years,
Okay.
and so we don't have a standard. We have some very expensive buildings,
Yep.
and then some more moderately priced.
Okay.
We've done what I would say one of the things is as we're talking about repositioning and repurposing buildings, for what we're doing, that wouldn't work because the operational efficiency is where you get a lot of the returns. And if your building is not designed for that, that would be hard. So we've done some renovations of hospitals and school buildings and all kinds of things.
Right.
Those are fabulous communities, but they're not operationally efficient. So I would, one of the questions that came out earlier, I would struggle a little bit with that, with the way that we approach it.
Gotcha. Tom?
If I could, so our cost per unit for this first one opened a couple of years ago was not roughly comparable, about 440,000 per unit. But the cost per bed was 221,000 per unit compared to 339,000 for a typical building, so 35% less. And again, that's the trick, because the shared occupancy. So we couldn't new build today for those numbers because the construction costs and so on, but that's what it was when we started construction 4 years ago.
Okay. Well, sticking in the construction range, and Gory, maybe for you, from a direct supply standpoint, as you guys think about the middle market product, from the FF&E, what you guys supply, how are you guys, thinking about it?
So for us, we're looking at the middle market on our innovation side. So really looking at what the product is aside from just the FF&E component of it. And for us, Judy, you stated it really well. We've always looked at the end of the day, it's all about understanding and ensuring that we have 100% operational efficiency and that you have an operating model that meets the needs of the resident pool you're going to serve. So when we're starting to look at developments, and I lead development services and planning services, we're talking to our development teams and saying, okay, you really need to understand who you're going to serve, who is going to serve them, and then start looking at land. For the middle market, I believe the solution lies in us looking at every layer of the development process and the operating process comprehensively from the beginning. So you can't have a developer going and putting something out without understanding what the component of who they're going to serve is. So looking at land that leverages everything, I think. So finding land in communities where you can have a conversation with the cities about, there were some really great ideas tossed around getting, rather than real estate taxes, a pilot program, which is payments in lieu of taxes, because these seniors are not going to be putting a burden on the school districts, increasing your FAR on the communities, trying to leverage any kind of community taxes that can be used for infrastructure improvement. So you take your land basis cost out. Then when you start looking at the building, starting from the inside out, Judy, absolutely correct, looking at every point at which you can bring operational costs down without compromising services to the residents, but also looking at partnerships. So location has a huge thing to do with partnerships. Can you leverage local hospitals, home health services for activities, universities, high schools for volunteers, the broader community, the retail community, all of those elements. So location and how that impacts operations should be considered. And then in the design, technology. What is technology going to do to how we serve our residents and their needs? Can the building itself become a smart building? At Direct Supply, I don't know, you guys have probably seen Bob Hillis talk about the smart chandelier. It no longer is just about light. It is about light that has light therapy, that brings your Wi-Fi into the community, that manages your HVAC community, has radar built into it, so you actually know whether somebody is sitting or standing, what their heart rate is, what their heartbeat is. There's a lot of innovation going on that I think our industry has to be embracing. How we fund it and how that gets capitalized is going to be the next part of the conversation. But I think the solution lies in layering all of those components together. And then the product, too. We're doing projects right now. We do about 200 projects a year. And a lot of it is going and repositioning existing communities. And we are looking at, those are really good middle market products if you look at it with that lens. And look at how, because the basis is lower, right? We're going into communities that have been around for 20, 30 years, but ensuring that what we do is going to meet those needs of the 2029 population when they come.
Judy, I want to go back to something you had said in regards to finance. So I think you said you have 3 different projects now with 3 different finance folks, right? Usually finance guys, you know, if they like what you've done, they say, give me more of that. So curious to see if the folks that you're working with now have asked for more of the same.
So, yes. I'll be honest, our first project didn't fill up as fast. It still isn't full. It has been a painful process.
Okay.
Our second one is doing well. What it has really proved out is the building design as well as the operational efficiency. Our margins are incredible. So that's been proven out. And our third one just opened a couple weeks ago, and it's off to a wonderful start. So it really will depend on how quickly this next one fills as to how quickly we will start our fourth. We will start our fourth, fifth, and sixth.
Okay.
It's how quickly we'll do it depends on when we get our cash back, so we can reinvest it.
And curious to understand the sort of the lessons learned as you've gone from project 1, 2, and 3.
So where we were really successful was on the building design, the type of construction, and the operating model. Very few tweaks between 1 and 3 there, and very few planned for 4. We built the first one in the wrong place, too small of a market.
Okay. Tom,
To be efficient, we built 120 to 160 apartments, and you have to have a big enough market to fill that.
Okay. Tom, your side?
We have just our first one open. It's done very well. It's nearing full occupancy, but it's been open less than a couple of years. We've been pleased with that. The other 2 are going to be opening within the next few months. And all we did from the first one, based on the experience, was in the first one we really had all shared occupancy units, and the next 2, we've thrown in a couple of 1-bedrooms just to sort of offer a little more variety. But that's the only real change we've made.
So the lease up, you say, is comparable to your sort of non-middle market products?
Yeah, it's been roughly the same. Yeah, we'd like them all to go faster. But
Okay. So as you look forward and you look at your split between your sort of middle market product and your non-middle market product, any sense of which one will grow faster than the other and why?
I think for us, I think I want to get maybe these next 2, get some experience with them and live with them for a little bit before we launch some more after that. So I think we're still sort of feeling our way to really understand sort of the customer and how we can operate it right, and sort of feel like we really understand exactly that we really sort of have this down. I don't feel like we're there yet. I think we've had a good start, but I don't feel like we're there yet. So I think we're encouraged, but going to probably take a little pause, get these next two, and sort of see where we are after that. Obviously, if we're feeling comfortable in a bit, we've seen the numbers, there's obviously a big opportunity.
And then sticking with you here, Tom, same question in terms of lessons learned between Project One and as you're looking forward to your future projects.
I think the change in unit mix, I think we again put in offered a little more variety in the unit mix was really the main lesson from the first one, that having sort of all the units be, we had 2 slight variations in the companion units. I think we just offered a few 1-bedrooms in the next 2 to give a little more variety. But that was really the main change we made. Otherwise, we were pleased with the feedback we got. We do a lot of market research as we go, of why people choose it and not choose it, and so on and so forth. And that was really the main comment that we got.
Gotcha. And then Judy, on your side, in terms of looking for growth between your 2 products?
It will depend on land and construction costs.
Okay.
Right now, it's pretty challenging to build middle market because the construction costs have just gone up so much.
Yeah.
But the next cycle is coming. When that hits, will determine that more than anything else.
Yeah.
Right now, with the land costs where they are and the construction costs where they are, you're forced into building a higher price product.
I do think that one of the things that's kind of a challenge to this group as we are kind of having this conversation about a social need to meet this need of this boomer population, the regulatory environment has to change. We were talking about this over dinner last night, where we need to bring those folks that are looking at permitting our buildings and the requirements they're placing around standards for construction that cost undue burden on the construction costs. For instance, the number of ADA units, or how big the units have to be, or the space that you have to allocate. We go in and we have lots of arguments and conversations with people to say, this works, this is a really good way to do this, and it's education and continuing to do that. So I think we have to take a look at that and see how we can build buildings less costly, still obviously meeting the needs of this population. The other thing is every element of a resident unit, the common areas, has to be taken into consideration. We look at we do life cycle costs or cost benefit analysis of the difference between putting a closet versus putting a piece of furniture in, right? You know, a closet, now you have to sprinkler that closet. So now my closet became $1,200 of maintenance and long-term care for it versus putting an armoire in. So we're going in and looking at every level. The little things begin to add up, which is what you found in your example. And but I do think at the end of the day, we cannot forget the consumer. I love the fact that you restated what this was. It's not an affordable model, it's a lifestyle model, right? So the idea of living together in an environment, having the high school pals that live together, that's amazing. And I think there'll be really good behavioral consequences to that we don't even anticipate now. So I think the next product, these are incremental changes, but there'll be some transformational changes that we have to embed within those buildings. And the regulatory environment has to be ready for that, as well as the capital markets, because joint multi-use, senior living and multi-use buildings has been a very little conversation to be had.
Right.
But the idea that we can leverage the land and the land development costs with another user that has different revenue streams could be really interesting for this marketplace. And I do think our next population of residents will actually desire that. So we need to start thinking outside the box about that.
Yeah. Judy, I think you wanted to make a comment there?
No.
Okay. Okay. So, look, so for the folks in the audience here, again, when we go back and take a look at the sort of the side-by-side performance, right? So what I've heard is, hey, look, the staffing model may be a little bit different because the services are a little bit different, right? Things like, labor PRD, different, food PDD, different. CapEx, seen anything different there so far?
Actually, our CapEx, this is one of the most expensive kitchens we've built because we put high quality equipment in the kitchen that reduces staffing. And so we really built it to be efficient in the long run and not the cheapest building up front. So really looked at where does that pay off, and particularly in the kitchen where staffing can be significant, if you can trim some of that down through good design and good equipment, in the long run it pays out. So our FF&E was very thoughtful. We looked for durability, we looked for a long-term value rather than just the cheapest we can get. And in the long run, that's working out to our FF&E going forward on the buildings is very, very low.
Yeah.
So it really is being thoughtful about what is necessary and thoughtful about design that is easy to clean, easy to maintain. Those are the long-term costs that add up in staffing, where you have to have the extra person in plant to make up for the poor construction, where you have to have more people in the kitchen for poor kitchen design. So it really is designing things well and efficiently in our model. That's it. Everybody's going to take different approaches. We are not willing to compromise on what our principles are about providing great well-being communities for our residents. We're resident focused, and we're not going to compromise that. But other people, there's you're taking a different position. You're doing share units, we don't do share units. There's a lot of ways to do this, but it has to be thoughtfully designed.
Yeah. Curious, acuity levels at your middle market
So our
communities.
middle market is that we have built so far. We're going to expand that. Has been independently, so it's independent license, but we provide space there for PT, OT, and home health that operate within the building 24/7.
Gotcha. Okay.
So that is provided, and that provides some other benefits for being able to build that out, as well as not having the startup staffing that you need to have. That allows us to keep the pricing down. So we'd like to be able to do our own assisted living within it, and that's what's coming next.
Yeah. And Tom, you're AL from the get-go, right?
AL and memory care.
And acuity levels, any differences there you're seeing between the middle market and the, no?
Not really, no. Nope.
Okay. With that, I think I'll leave it up, some questions out in the audience here, so. Steve?
I'm going to play devil's advocate a little bit here. So something new and different, right? Surprise, surprise. So it just seems like all the talk has been about take our assisted living model today and how can we downsize it, make it cheaper to build, staff it more efficiently, more efficient food process, all that kind of stuff. So, and I understand that. But I look at 2029 and how the elderly are going to eat, transport, socialize, who, where, and how they're going to get their health care. All that most likely is going to be extremely different. So if you take that into account, shouldn't we be thinking about a completely different kind of model than just downsizing our current assisted living?
Yes.
Yeah, that's not the
Yes.
conversation we were having.
That's absolutely correct. I agree.
With you,
Yeah, it wasn't. I mean, it seems like everything is just, assisted living, taking the steroids out.
Well, I think
It's not a different model.
one of the things that I think that we, as a follow-up to this, this is the start of the conversation about understanding what this cohort is, but I do think understanding how the layers of the other components of how these folks are going to want to age. What's the lifestyle that they're choosing? The fact that they like a socialized model could be very indicative of what could happen. I think the other thing is, I keep saying this, the technology component and how we partner with healthcare, that all is going to have a significant impact in the product. And I believe that notion of wanting to age in place, I think that's why your IL model works so well, right? Because you're able to provide it because you plan for the partnerships for those elements. I think those are all going to have to be fundamentally built into the model that's going to evolve for 2029. We're nowhere there yet.
And then you have to look at what happens when the Medicare Advantage plans start getting into the housing market and how that's going to disrupt things.
Is that a question, Steve, or is that?
It's a statement.
Time for another question here?
So I got the mic.
Oh, sorry, go ahead.
Jody Holtzman, Longevity Venture Advisors. So there's MA getting into housing. Housing's already getting into MA. Should be the most profitable MA plans on the face of the planet. But in any case, the thing that I'm not hearing, and after running research at AARP with a focus on who these people are, I'm not really hearing the want, right? So we have all these data that are focused on an assumption of need. I want to know, given the discussion, there's been little bits about occupancy challenges, that in this market, and there was a reference to that the first, effort out of the box, was slower. Out of these numbers who need housing at some point, how many of them want to live there? I mean, it's a challenge. I do an exercise at leading age conferences and whatnot, and I ask everybody who's, proudly managing any kind of senior living to stand up, and they all stand up. And then I say, and please remain standing if you're looking forward to the day you live in your facility. And anywhere's up to 95% of the people sit down, and I think that's reflective because they're like everybody else. They mainly want to, age in place. But they also know what these places are, and it is not the vision of life that they want. So how do you address that?
So we did design ours for it's designed for what I want. And it is designed, it's modern looking, it is a social model, it is what I want. It was designed around a profile of not high end, I don't want to be waited on. It's not what my mom wants, it's not what my dad wants, it's what I want. It's the type of life, the type of apartment I would live in, the type of building I would live in. It is designed, we spend a lot of time looking at our psychographics and who our customer is. We spend a lot of time talking to the customers before we build. And so I would say, I would be one of the ones still standing. I would live in our community because it is designed around not what we have done in the past, but what we're looking for, what I'm looking for in the future.
I would say a couple of things. One is I mentioned briefly the notion about the way we describe and how our community is actually run as a social, we emphasize the sociability of it. And I think we know social isolation is a big issue, and people, that's really been the big attraction to the community. It's not been the price point. We don't talk about the price. It's located in a more modest income community, but people are drawn to it because of the sociability of it, and I think that's very much a want that people have. I think there are a variety of different market segments, so people have a variety of different desires, and I think those are going to shift with the baby boomers coming. I don't disagree with your point, but I think this community too was based on a lot of market research about people who want a social setting where they're not going to be isolated in their home, and it's met that need. But I think, will those needs be evolving and changing for different market segments? I don't disagree with your point at all. We weren't asked to discuss 2029 future vision. We were asked to talk about middle market, and I think we've done a good job in this particular community meeting a need in a middle market, but not having people feel like that's what it is. The community they're moving into is a high sociability community, and that's what they like about it.
I do think that you bring up a really good point, because I do think that again, the cohort of the population is there. We understand we're beginning to understand better what they can afford to live in. We don't understand yet how they want to live and how they want to age. And so more research has to go into that. We need to understand that. The idea, I hear a lot more about, I don't want this last stage to be where I go to die, right? I want to be living a purposeful life. I will recognize that I am frail and that I have some mobility issues, but that doesn't mean my brain isn't functioning and I can't be part of it. At the same time, remember, we are going to have a staffing struggle because we just don't have enough people to serve this population. So this population will also become a part of our staffing and our lifestyle solution. And so how we look at operations is going to have to transform, and subsequently the buildings will come to match that. We just did a quick survey for an event that we're doing, and one of the first questions was, please don't call it senior housing. You know, at every stage of my life, when I go through life, you know, you go into college, you live in the dorms, you go get your first job, you live in different environments. We never tie that to your age. We tie it to a lifestyle, right? So why is it when we come to this later stage in our life, we talk about it defining ourselves to our worst attributes at that point in time? So I think as an entire industry sector, we have to start thinking about it differently.
Hey, bad news is we got to cut it off here. Good news is we got Bob Kramer coming on next. So thanks, guys.
Thank you.
Sorry, thanks. So it wouldn't be a NIC event if we didn't have Bob. So I have Bob Kramer coming up next. He's going to wrap this all up, and he's going to get you all riled up to go out and go build housing for middle-income seniors. Take it away, Bob.
Thank you. Where to start? This is not going to be just me talking. I know nobody believes that. But I want you to be thinking, because I'm going to actually call on a number of you. What's your takeaway from today? What's your key takeaway? And the second thing I want you to be thinking about is, what haven't we talked about? Because this gets at a couple of questions, Steve Monroe's, Jody's. What have we not talked about that we should have talked about if we're really going to meet the needs of the middle market? So your key takeaway, one thing you heard today, maybe it discouraged you, maybe encouraged you. Remember, overall, our thesis here is that this is as we look to 2029, this is a huge market, which for the most part, we're not serving now. It's going to grow exponentially in size. And the size that we've talked about in 2029 is really only the beginning. There will be 20 years following of enormous growth in that market, particularly because we know, and many folks would say, and I would agree, that the demand, particularly on the care side, from boomers will be greater in their late 80s and not even their middle 80s. Well, if you're talking about boomers in their late 80s, then, we said the first, in 2029, the oldest boomer will be 83. So we're not even quite there yet of highest demand. So in one sense, part of having this discussion is having a discussion to think about, all right, how are we going to take advantage of this opportunity and also meet the need? And I would say with that, it's, one theme that we've touched on some has been that this is a combined public-private sector effort. That's the good news. The bad news is, I would argue that if we as the private sector aren't part of the solution to this, they'll be hell to pay. Put another way, when communities, states, because of their Medicaid budgets, communities, because of all these elders that are living in housing and basically are shut-ins and aren't getting the care they're needing, and their nightly news talks about all the stories. And at the federal level, we're dealing with unsustainable pressures on safety net programs. And if this industry is only seen as caring about wealthy elders, they'll be hell to pay. And you think regulations are tough now, they'll be 10 times tougher. You think the coasts are a great place to operate now, they'll be 10 times tougher to operate in. You're concerned about mandatory set-asides now, or we are, they'll be much more demanding, and they won't be at 10 to 20 or 20%. So that's because the reality is this is a huge untapped market. It's also going to be a huge social need. And it's also a social need that's going to put enormous unsustainable pressure on our current safety net programs. And so I do think, to the discussion that we've had about sort of the relationship between policy and what we can do in the private sector. The pressures that the public sector is experiencing and will really experience. We haven't been in a crisis yet, so we can still demagogue across parties and so forth. But the pressures we will face are going to create more opportunities for legislators and policy folks to give you more flexibility if you show that you've really got solutions that can indeed address the needs. So just a few thoughts, and then I want to put some people on the spot. And so my role is to be agent provocateur and to also sort of just sum up some of the things I've heard. So briefly, I heard that on the equity side is probably the greatest challenge. Where's the equity going to come from? Where's the cash going to come from for developing that project or for repositioning that project, if it's a reposition? And I heard some ideas, but I didn't hear a whole lot of, as I heard on the debt panel, well, the debt piece will be there. I didn't hear that confidence at all on the equity side. I heard on the operating side that there's a ton we can do with efficiencies, and what I would observe there is that the private pay seniors housing industry, so to a certain extent, has followed an MO that it's never gotten away from, which is it distinguished itself from skilled nursing. It distinguished itself to its market by saying, look how beautiful we are compared to skilled nursing. And then as more folks entered in, the competition was how much more beautiful you were than the project down the street. And just as the original assisted living, the curved staircase, the Victorian mansion of, say, Sunrise, the huge chandelier, the Edwardian furniture, and the carpet, that wasn't for the senior. That was for the adult daughter, and it worked. And the adult daughter who really drove the growth of assisted living said, wow, now I don't feel guilty. I can have mom move here, and I don't have to leave my job. And assisted living took off in the 90s. But as a result, we've been focused so much in the industry in differentiating, offering the same product and differentiating by our bells and whistles. And now, what I heard the operator panel uniformly say, we're looking at the price point we have to deliver, and then figuring out how do we deliver what the customer wants at this price point. And that's, I think, a whole different way of thinking about it, which is exciting and encouraging. And I know there are other examples. I know Dan Lind and Presbyterian Homes and Services have been quite successful with their middle market communities doing just that, and literally having focus groups with residents, prospective residents, where you're discussing the price point and saying, look, there are trade-offs. What's more important to you to have and what's less important in order for us to deliver a product that you can afford? And so with all of that, so operating side, a lot of focus on efficiency and enormous gains there. It was mentioned, we didn't get into it much, the impact technology could have, particularly on that efficiency, and particularly better use of staff. That came out a little bit in some of the discussion, but we've hardly even tapped into that, and I imagine for models that were designed in 2014, there might be a lot of different thoughts in designing that model in 2019 and how technology could create much better use of staff, so that particularly care staff are working to what I'd call the limits of their license, rather than doing a lot of things that are really a poor use of their time. That through robots, artificial intelligence, all sorts of things, they could no longer have to spend their time doing that. And therefore, they're actually providing human interaction time, not routine task-filling time. I also heard that perhaps the easier place, not that it's easy, but is looking at a more multifamily type product that is more on the IL side, but creates a a fun, I'll put it that way deliberately, socially engaged community, but doesn't put the focus as much on the care. Because the care is the tougher piece. And so that there might be a lot more real estate capital initially comfortable with that piece, because we're not trying to deal with the care and labor and, gee, how do you solve that problem? And then the real challenge would be that 85+ population in the care piece and how we're going to think about that. And it was only sort of briefly mentioned by Steve Monroe and Jody. But I think here, one of the questions that I'd like to throw out to the audience is whether or not, when it comes particularly to thinking about how we're going to solve the care piece for that older the 85+ population, will the first entrance on the equity side not be real estate equity? Will it be completely different players coming in? And candidates I'd mention, one would be large insurance plans with MA, who would see the opportunity of wrapping basically a managed care product around a seniors housing platform to serve a middle-income market whose lives they have healthcare cost exposure or risk for, and being able to offset some of the costs of the care through the MA plan, so that that's one way to address some of the care issues, and ultimately believing they're saving themselves dollars because they're keeping people out of institutional settings and keeping them healthier longer. And so I also wonder if we've had this age-old debate ever since I've first been in the industry. Is it real estate? Is it an operating business? Well, that debate still becomes very current today when we think about financing, and particularly when we think about the equity. And so it'll be interesting, I think, whether or not it'll be the non-real estate, the folks that invest in healthcare services. Will they be the ones to step up and see this because of the combination of seeing seniors housing for very frail seniors as a healthcare play, as it's primarily an operating business that happens to be on a real estate platform, and therefore that the rather than TPG real estate, TPG healthcare is more interested in making that investment. I don't know, and I'm being deliberately provocative, and some of you may think I'm totally nuts. But if you're going to launch a conversation about a tough issue, you've got to put out different possibilities that some people think are nuts, that might be controversial, to get that conversation going. Another thing that hasn't been raised here, but certainly others have raised, has been the idea of a small house model, a prefab, a modular model, particularly one that would be sort of heavily wired for technology, so to speak. And, there's the issue of size and scale with that, and particularly when it comes to care, how do you address that care issue? And then the last issue I'll raise, and just in sort of my observations and what I've heard, is on the care side. It's both an opportunity and a challenge. When you're in a moment of disruptive innovation, and I think the next decade will be very disruptive in our space, but it overlaps, and in fact, it's very connected to the disruption going on in the healthcare space. And that product, that's not so much the product in terms of that independent living product that's just focused on lifestyle and has no on-site care. There's going to be the Apple Watch, and it's going to be heavily technology, and people will be monitoring their own health. But the model that has the on-site care, the comment was made, when we're in the comment was made about the issue of labor and regulatory burden. And regulators always look back. Policymakers, if they're good, look forward. There's always tension. But when you're in a disruptive innovation, the gap becomes far worse because the policymakers are trying to go, and hopefully the market in this issue, a whole new direction, and the regulators are still looking in the rearview mirror, trying to prevent things or regulate things that were really yesterday's issue and yesterday's problem. Nowhere do I think that's more true than in the labor challenge that I think many of you have identified, many of our panelists, as ultimately the greatest challenge here with regard to serving this middle market, particularly for those that need some sort of on-site, not just social support, but care. But I think that creates a great opportunity. If we're at the table, if we're working, whether it's with municipal governments, state governments, federal governments, to show them what we're doing and how we believe we can address this issue. Ultimately, we will have to, as a country, be more creative in how we think about the care piece. Some of you have heard me say, 20 years ago now, I worked with a major seniors housing provider because I introduced the pastor of a very, very large, 20,000 plus African American congregation to them. And the pastor wanted to basically build an assisted living community. But his thesis was, we have a huge congregation, they're really into volunteering. And we think we could defray the costs by taking over a lot of the responsibilities of staff in the community. And there were a lot of discussions. There was great excitement about this model, both by the seniors housing provider, this was an assisted living model, and by the church and its leadership. And then two folks got involved. The state regulators were asked their thoughts, and the attorneys were brought in, and the project died. The regulators said, you can't do this. There's no way you can use volunteers in this setting. We will never allow it. And the attorneys said, from a risk management point of view, this is a total disaster. When we look at other countries that have aged faster than we have, we see that they use the less frail to care for the more frail. We see that in many cases they involve volunteer and particularly family caregivers as a way to defray the costs for that resident and that family member. There are innovative things that can be done. Regulation-wise now, they're impossible. But it's only by being, A, seen to be at the table, B, being serious about figuring out models that can address this cohort, and C, then bringing attention to the fact, look, with these labor costs, and they're only going up, we're going to have a more flexible attitude to how we think about the labor that goes on in our buildings. And that's both from a risk management and legal point of view, and from a regulation point of view. So, huge market, great opportunity. With that opportunity, some things will really have to change to be able to really serve that market. The last thing I'd close with is when we think about seniors housing and care, I think I was at a conference recently, a major national conference in the healthcare field, not our field, and the statement was made, and there was a panel discussion on social determinants of health, and the speaker said that social isolation will be the chronic condition of the 21st century. And what he meant by that is from a social determinants point of view, social isolation, and the research is increasingly showing this, is one of the most debilitating things and therefore most costly things to our overall healthcare system, not to mention for quality of life. It's fascinating how you're starting to see insurers who are taking risks, seeing the seniors housing platform, it's gone from being irrelevant to suddenly potentially being the place that becomes care coordination, care management central. And CMS is starting to see that opportunity too, just starting to. So I believe that with the understanding that health is not just about health care, that health is about much more than just medical services being delivered. Suddenly the relevance of seniors housing, of what we do, to the national challenge of how we're going to provide housing and care for elders, particularly frail elders, has never been greater. But to do that, we're going to have to also figure out how we're going to serve this middle market. So with that, let me stop. Those are a few observations. Okay, comments on that, or you can say, what's your one takeaway that you've had from today? Comments? You know, Bob, you're full of it, or, you know, a takeaway that you've had from this morning's session. This is only a start. I mean, we're trying to start a discussion. The first thing you do when there's a great opportunity that's also a great need is you shine a light on it, and you try and quantify it. And again, Beth thanked her. We owe an enormous debt to Judy, because Judy really pushed NIC ever since she's been involved. She said, if the private sector is going to serve this market, you've got to define it. Who is it? How big is it? What can they afford? What kinds of health and chronic conditions do they have? And Judy, thank you. You've consistently pushed us ever since I've known you to focus on this and do this study. But it's the beginning. So, all right, I saw some hands. Yes, Imran.
So if there's 8 million seniors, right, that qualify in this middle income cohort, if that penetration rate nationally is 10%, where are 800,000 of these people being taken care of? Why wouldn't that same model work, right?
Then going on today.
Yeah, why wouldn't that model continue to work for the additional 600,000 if you assume the same penetration rate exists, right?
Well, first of
or
all,
down the road.
each year that goes by, you're having, as folks the folks that are moving in, so to speak, to our communities are progressively having fewer children. A fact we didn't talk about, one of the interesting things is the middle market amongst the three cohorts is the most likely to have children not living near them. That's huge. So as years go by between now and 2029, fewer defined pensions, a cohort that's saved less, a cohort that has less children. So the point being, we're serving many of those folks actually today. They are less likely to afford our product in 2029 than they were in 2014, or they are today. So we're going backwards, not forwards.
Maybe I should clarify my question. Part of it is, you know, as newer facilities get built and Class A gets built, same things happens in multifamily, right? The older facilities, nobody builds Class B per se, but that becomes the Class B. The older product becomes Class B. So what I was getting at is, why wouldn't the same thing happen here, right? The older product becomes Class B, and there's aspects of, you know, labor and other things that come into play. But I'm just saying, from a dollars per unit perspective, that's what brings it down.
And a lower cost. I agree. At the same time, I'm sometimes mystified by the pricing that I see the older properties trading at in the market today. And, you know, for that to happen, there has to be a recognition in the market. And people, you can't be getting what seem to me to be the very high prices for those 20 and 30 and 40-year-old buildings. I agree with the thesis, but I'm not sure the pricing in the market now is going to enable that. That'd be my observation. Yes, Carolyn.
Bob, one thing I didn't hear about is something like mixed income housing for seniors. What it felt like to me after the sessions had ended, fantastic ideas, but it's, okay, let's build this over here for that group, let's build this over here for that group, and then you've got the affluent group. You know, I'm kind of curious whether the properties that were successful with Benchmark and 180 would be attractive to the more affluent cohort or not, and whether there's an opportunity to design a mixed income model that helps deliver maybe better returns, or help cover more costs. So that's one takeaway. I thought that was missing.
Thoughts on that? Anyone? Yeah, Pam.
I was actually suggesting you take a market rate facility and make 20 to 25% of it targeted for middle income, and look to get that through a city or town by getting additional rights to build more units, so the land basis is zero, and your return will come down in total, but it's just something you can do, and then try to work with the community to get some sort of real estate tax break. But it would have upwards of 25% be middle income, and the rest would be market rate. Because you do that in multifamily every day in a
Bob.
lot of cities, and it works.
I mentioned
Yes,
that
Tom?
we have benchmark, we have now about 5, but our state housing finance agency, I don't know, 20 years ago or something, had an 80-20 program where 80% of the units were market rate, 20% were low income for folks who are 80% of the median area income or less. And we've got 5 of those communities now, and they've been great successes. And you go in, you wouldn't know who's who and all the rest, and they've been terrific. So there are models out there that do have mixed income and that have worked very well. So.
Other thoughts? Yeah, let me just say on the sort of pilot payment in lieu of taxes, I will say that that argument or that thesis to local governments will be far more powerful in the future if you can show that you manage chronic conditions effectively on site and don't use the local paramedics as your overnight shift. Because I've been part of discussions in a lot of local towns and been asked as an expert. And they get the bid on schools, but their biggest concern really is the burden on healthcare services and particularly their EMS. And so senior living communities that really have a handle on their hospital admissions and their ER usage are going to be able to far more effectively make that argument than those that make heavy use of the local fire department and EMS. That is a real problem for our sector if you're going to go to a municipal level and try and argue for some sort of tax break. Question or comment here?
I think what Bob added at the end was interesting when he said when you go into the building and it's 80-20, you don't know who's who. So I think that's a real issue. I mean, people live in neighborhoods with people of their own income, their own demographic, and that's just what people want, which gets back to the problem that Pam and Judy touched on. If the projects don't pencil, it's just not going to happen. I mean, Judy said she needs to build to 120, 160 units of building because otherwise you don't have the economies of scale and the efficiencies. Andrew said that social impact is great, but the investors need returns. So at the end of the day, if the incentives aren't there for the projects to work, it's just not, the projects aren't going to exist. I mean, that would be my response to your question.
Back here?
So just one thought on kind of the debt and mixed use. There is a program out there that doesn't get used very much at all to finance affordable units, and that's the 142D program, which is tax-exempt bonds that private developers can use. There's a few issues with that. A few tweaks, I think it will help immensely, but there are programs out there. And I guess the other point of that is in any type of product, trying to move this to the middle market, there's going to be a higher cost of capital to begin with because it's an unknown, right? The overall cost of capital is going to be higher. So how do we start the process of developing a model that works that we can prove out to the equity investors and to the debt investors? And I think the only way that that's going to happen is some type of public-private partnership that we need to be thinking about, or some foundation-focused event.
Yeah, and I think it's a good point. I think one of the reasons we want to bring attention to this issue now is that, as I said, we are serving. I mean, we did a study in 1999, some of you may remember that far back, which showed that basically 2/3 of the residents in assisted living, by income alone, shouldn't have been able to live there. In other words, they couldn't afford it. And they were only able to afford it because of a conscious, not a get quick down to Medicaid, spend down of their assets and the adult child contribution. And it was only when you understood that triple bucket that you could understand how all these folks were being served in assisted living. And I would argue a lot of that's still going on today. So we are serving a lot of that middle market now. But for all the things of the profile in 2029 we put up, the challenge for that middle market to afford our product is only going to grow. At the same time, their need for that product, because of the lack of availability of unpaid or family caregivers, is only going to grow. So that's why we're putting, to your very good point, it's going to take some time to do this, to try out models, to get capital comfortable. And, maybe it's, social impact family office. There are definitely folks like high net worth individuals that want, there are folks investing in things to deal with global warming and to deal with sustainability and all sorts of issues. Well, this is a really key issue. And especially because some people get, if I want to protect the safety net programs we have for the poor, we've got to address this issue. Because when you look otherwise at what would happen to state Medicaid budgets and the impact that would have on education budgets in states, it's devastating. Just absolutely devastating. So this is an issue that will demand attention in the future. And we have an opportunity to be out in front of it, be part of the solution. Yes, back here.
Yeah. Hi, Bob.
Lynn, hey.
Couple of things I learned. First of all, I want to say thank you to Nick, an industry group that put this issue on the table. I think for us to put the issue out there in the way that you did is a really great first step in saying we want to be not only part of the discussion, but we want to be an equal at the table. And I think a couple of things became clear to me. This three-legged stool idea, so efficient capital, efficient construction, and efficient operations are really interesting. We also need efficient regulation. And the only way we're going to really get that is to all be seated at the same table. And I think my takeaway today is a couple of things. One, we have to continue to move in the direction where we open the dialogue rather than stay away from it. Because I believe we need that partnership to be successful, particularly in meeting the middle market issue. A couple of other takeaways. Repositioning. Tom, you talked about it in terms of providing a lifestyle product rather than a care or a real estate product, and I totally agree with that. But that's a repositioning that has to go far deeper. It needs to address a whole host of issues in terms of our day-to-day operations. How do we provide activities? How do we staff? How do people look at aging? How do people look at what we do? The social determinants of health that you mentioned, Bob, are the big issue. If we can prevent expensive disease, right, that has to be treated, well, then we've just created great value. So if we can show that and reposition not only what we do, but how we message it, I think that's really important. So my takeaway is we need to do more consumer research, really understand what our consumers want, to your point, and then be able to talk about it in a way that meets our consumers' needs. We have to talk about it in a way they want to hear it.
And I would thank you, Lynn, and I would just add to that. I think that it's going to be critically important as we talk about 2029 and beyond that we understand how our customer is changing and will be changed. And that has huge implications. It was mentioned earlier that they're not going to want to move into anything with the name seniors on it because they don't want to be called a senior. And seniors housing, I think particularly, we showed that this will actually be a higher percentage of women. Boomer women are the generation that fought for the rights to their bodies, for their rights to equal pay, and for their rights to be in the workforce. They are not going to accept a condescending model that says there's infant care, toddler care, and then there's senior care. It won't happen. And to the extent you're promoting that model, you will go under because it just, it's not going to be successful. At the same time, there's a very interesting phenomenon, and we're already seeing that in sort of boomer-oriented things, the village model, shared housing, co-op housing, so forth. What is that? It's the return to the college experience, reinvented when you're in your 70s. It's communal living, college style. And I think we're going to see a lot of that, and I think it will influence what can happen in our communities. And I think that the idea of social connection and that sense of purpose. Some of you heard one of our NIC talks. Lisa Ryerson challenged the industry, saying it's in your DNA, but you need to rethink your activities directors. They should be purpose matchmakers. And I love that phrase. And I think that's the sort of thing boomers are going to want in the future. The care, yes, but that's in the background. I would argue that with the rising acuity of our residents, we've stopped selling actually the social model. We're selling care, and so people want to avoid moving there because it's a place you move to when you have all those needs. And the reality is, yes, there are exceptions, but for the most part, the image of assisted living is a place you go to when you have to have that care. It's better than nursing home, but it's still not a statement about you that you want to be making. And so when we're selling lifestyle, I think that's different. And ultimately, that human connection. Ryan?
So this is great that Nick has put the spotlight on this issue. And I would say the biggest takeaway, I'm sure for many of us, is putting numbers behind the demand today and then in the future. I think the question now is a little bit different. Is your tent big enough? Because are you trying to solve how to solve middle market for senior housing, or are you trying to find housing for people that are in the middle market that are aging? Two different questions. I think today we spend some time focused more on senior housing models applied to the middle market. When you frame it differently, what are the housing models for the aging middle market, you come up with some things you just mentioned. That tent would likely include multifamily here. I mean, Pam's comment earlier, there's clearly a lot of capital today for multifamily in the aging cohort. Can you make that better? Can you make that better? Are there ways you can get the purpose matchmakers you reference embedded in that model? It doesn't necessarily solve your 85 plus higher care dimension, but if you bring it up a bit, who else should be in this tent? And how do you segment it? I mean, even things like Silver Nest, where they're trying to help match up people to share rooms together. There are a lot of ideas out there, so I think framing it is important. Maybe there are two different work groups. Maybe there's a work group that's very explicit, 85 and older, higher care, how do we do that? And there's a separate one, which is this broader tent. But I think a little bit about that because I think that if you're trying to increase supply to cater to this market, there's ways to have it happen much faster, potentially, by making certain models better than they are today to meet some of that. And by the way, affordability is an issue in every age group right now. So that piece is not unique necessarily to aging. So I think there's opportunities in how you frame this, but kudos to put the spotlight on it because a lot of people it hasn't happened before.
Okay. Thanks. Well, with that, I want to be conscious of our time. So thank you all. I hope that you will have a takeaway that then you'll go back with your team at your firm, your company to discuss. And I hope that you'll also, we want to bring a spotlight in the future to ideas, both in terms of models and, the four areas that have been mentioned. We've mentioned development efficiencies, we've talked about operating efficiencies, we've talked about capital efficiencies, and then the last one that Lynn mentioned, regulatory efficiencies, or I might say inefficiencies. So, but we need to put a spotlight on that, and NIC wants to continue to do that. So thank you.
So with that, that's a wrap. Thank you all for coming. Appreciate it. Thank you all the presenters. Thank you all for participating. If you want any of the materials that we saw today, you can find them on our website, www.nic.org/middle market. Thank you very much.